Jack, you talk about the need to really be more self-reliant when you talk about the supply chains. Electric buses, I'm thinking about another company, BYD, of course, a Chinese company, but has really sort of doubled down in the US and built out a big presence in California where you are as well. How do you see the competition coming from there? And when you look at the broader market, who is the biggest competitor to Proterra?
So we operate in a number of markets today. Certainly transit is one. We're the market leader here. We've sold more battery electric vehicles than anybody else in this market. We have a first mover advantage here with our technology. Beyond that, another key part of our business is what is called Proterra Power, where we operate as a tier one supplier to some of the biggest commercial vehicle manufacturers in the world. Daimler and Komatsu are partners of ours.
So what's the
our products go
based on what you just said, that really nothing's going to happen?
Well, then I think that there'll be people who say, I've got to go buy the industrials. He's giving you a green light to buy the free ports of the world. Chinese trying to fight you in that.
Chemicals?
Oh my, chemicals, yes. I have Lyondell on tonight. One of the reasons I want them on is because that's the quintessential stock to buy. If you believe that he says, look, nothing I say, Steve, is deviant from what I've said before.
Really? Because Paul Tudor Jones said it's the NASDAQ you want to look at, right? That can go up 20% if they do nothing.
Commodities. Lyondell said.
Well, he said commodities too, but he said the NASDAQ could go up 20% if they do nothing.
But, we didn't even talk about the 32-year-old who's now in charge of the FTC.
Lena Khan?
Yeah, Lena Khan, who, by the way, just for the record, spell check always makes it come out Line Con.
I know you're making jokes here, but how much of an issue is her appointment to big tech?
Okay, here's why I know. Because if you break up Amazon, say, there's notes today about everyone loves Amazon, it would be worth a lot more in pieces because the Prime's worth $1,000. If you break up Facebook, then you get both Facebook and you get Instagram. If you break up Alphabet, holy cow, bring it on, we'll sell Waymo, right? I mean, that would be the greatest thing in the world. Apple's now a health company. Give it a PE of 32 like the health companies. That leaves Netflix, which we saw this morning in a note that was just, I think, sage-like. There it is, right here. JP Morgan's incrementally positive. They like the slate. So obviously, JP Morgan's looked at the new movies and new series and likes them. I have not. We do have some people here who watch what the series are. I mean, obviously, Netflix now no longer bound by COVID can start doing some of the things it used to do.
So Amazon
and Lupin, by the way, started.
Amazon, popular show, favorite by a lot of people. Amazon, which is, I mean, it feels kind of late that Jefferies is adding it to its top pick. They're taking off Alphabet.
Yeah, that was needless.
Amazon's your favorite.
Oh my, yes. To the moon, as those guys used to say who were one time involved with that thing.
The Journal, though, this morning has an interesting read on how Apple's sort of move to become this health company isn't as perfect as everybody is making it out to be.
He came on Man Money, so listen, his legacy is going to be healthcare company, not mentioned, of course, in that article.
I know, but it doesn't happen overnight, Jim, right? I mean,
it's happening the watch. The watch is going to be how you regulate your life. I mean, when my wife had the auto light go on her car, which is years old and has like 160 miles.
Like the engine light?
The engine light, right? Now, we spent more time with the engine light than we have on our health all our lives. But the engine light, I mean, but when this watch says you've got the engine light of your body, that's going to be Tim Cook's legacy, the engine light. This is going to be your engine light. I got a picture of my wife there with me. It's really great. I wish we could do a close-up. But that's his legacy. And it's going to be the watch, and it's going to be tied into blood pressure. We're going to know whether you're about to have a heart attack. 600,000 people die of heart attacks needlessly. That is Tim Cook's legacy.
Okay, so that's big picture legacy. What gets the small picture? No, but I want to know what gets the stock out of the 120s. It's been sitting there for a while.
You sound someone calls on the show and says, you know what? I own Amazon, and it was up 200 points last week. It's not been up today.
But Apple's like, I don't know.
Apple's a big last year.
It sits at 125 forever. Now it's at 129.
725. Now it's 712. What is that Jensen Huang doing out there? No, I mean, come on. Apple was up huge last year. It's consolidating.
Okay, well, when does it finish consolidating? Because Amazon was consolidating too. That's starting to move. When's Apple going to really start to move again?
You cut me to the quick. I don't know. I think it has to report a couple of really great quarters where we see the ancillary products. I was at the Apple Store yesterday just to be able to say, of course, if you asked me about that, it was packed. we had to wear masks. But if the accessories and the service revenue stream go up, and we give the value Apple by long-term value of customers, as we got a note today for Amazon saying they're worth $1,000, then we're all going to raise estimates of what this company's worth, and that's what's going to happen. That's how Apple's going to go higher, and Apple Plus, all the different ancillaries, Apple Pay. When people start valuing these for what they're worth, then the stock is going to go much, much higher.
Shepard's, I'm looking at the way we have opened here, and obviously we're in wait and see mode for later this afternoon. But the banks, for example, are placing their bets on what's going to happen today, and that's nothing. That Jay Powell's not going to announce anything really substantive about tapering, but all the banks are down off the open. They've been down this week. They've been down this month.
All right, here's what. Remember Treasury Secretary Rubin? So I interviewed him when I was at street.com, trying to make news, okay? He starts the interview by saying, I want to tell you right now, nothing I say is making news. On air, on record, nothing. So if you even say for a moment that there's new news here, I'm going to dispute that. So I want to repeat again, there is nothing in this interview that really matters. It's not going to change anything. And if you say that I've changed my mind, I will discredit you.
But you're saying that even if he comes out today, Jay Powell, and says, we acknowledge that we're talking about tapering, that's not new news, that they put it on the table. Yes, we are talking about it, but we still have a long way to go before we actually get to that point.
Are they supposed to just sit there and talk about the nets?
I mean KD's performance last night was epic. You think he didn't watch that?
He talks about KD. I too think that there is an issue here, which is that to admit that you're talking about it, the only way to combat that is to say, this is not news. I admit we're talking about it. This is not news. We've thought about it. This is because you see, when the hecklers, also known as the reporters, go after him, of which I've already said, just cut it to 4 or 5 people, Jay. Not everybody. Draw straight. Have a little lottery.
Leasman.
Well, it's whatever. But it just pick 5 names out of a hat, okay? And those are the only 5 because. I mean, really, Jay, don't you have better things to do than sit there and take the same question over?
Yes, brother.
He's kind of locked it, but you ought to say at the beginning. I'd like to just say, as Jim Cramer told me to say, that would make my head so big I couldn't get through the door, but I would like
imagine?
that.
We'd have to take down the plexiglass around this thing.
Absolutely. As Jim Cramer told me to say, nothing I say is news. So if you say it's news, no, I'm not kidding. Yes, said he can leave my name out of it. I'm happy to give it to Jay because I like him so.
Okay, so what's the post-Fed playbook based on what you just said? That really nothing's going to happen.
Well, then I think that there'll be people who say I've got to go buy the industrials. He's giving you a green light to buy the free ports of the world. Chinese trying to fight you on that.
Chemicals?
Oh my, chemicals, yes. I have Lyondell on tonight. One of the reasons I want them on is because that's the quintessential stock to buy. If you believe that he says, look, nothing I say, Steve, is deviant from what I've said before.
Shepard Smith here. Thanks
Did
for
you look at
watching.
DraftKings, by the way, since we talked about it yesterday?
Yeah, well,
right? We had the Hindenburg report, and then we had another report that Cathie Wood
bought 900,000 shares.
$42 million worth.
This is interesting.
Not insignificant.
With Hindenburg, this is, I think, look, again, I work for DraftKings. I think Jason Robinson runs an outfit where he literally could take this one division and just sell it to somebody for $1, and then Hindenburg is ST to the division, and then Hindenburg would have to say, you know what? No harm, no foul, stock goes hard. All Jason has to do is get rid of that one division, of which he could. He doesn't need it. It's 8% of the revenue.
But let's just take the move that Cathie Wood made. Take the story itself out of the picture in terms of what drove DraftKings down. Let's just say a number of those ARK stocks go down. Did Cathie Wood, is that the right playbook? If
she's been buying
number of these, she buys all the way down.
She's been averaging down.
That's why I asked you, is that the right play for the average Joe who is in Cathie Wood stocks? You get hit, you buy. You get hit, you buy.
That historically has not been a good way to run a fund. Now, remember, she doesn't run a fund. She's always anxious to tell you that the inflows don't matter in ways which I don't really fathom, because it's true that they do matter, even if it's an ETF. But I would say going over Hindenburg stuff, and I know Hindenburg, and totally backed him on Nikla, totally backed him on Lordstown, backed him on Clover, did not back him on Grow Generation, because the fundamentals were too good for the pot industry. Notice they don't call it cannabis. Cannabis is how they try to get it. They try to upscale it. I think that what matters with DraftKings is gambling, whether more people will gamble and whether they have a low cost of acquisition. That's what matters, not this division that they can get rid of tomorrow. So Kathy Wood, I think, ultimately is going to be right. If you have an NFL season where more people want to gamble, do you think we're going to remember this little division that's 8% of their business? No. Legal gambling is one of the most important trends in the country.
I know.
Every state is bankrupt.
It's not like they're the only players, though. I mean, Penn National's pretty good, right? That stock's pretty good.
There's room for Penn Nat,
right?
And they got that Barstool. That's very good. Hey, listen, there's even room for FanDuel for when it comes to that. I mean, but I think when you look at DraftKings site and you look at the money they pour into it, they want to be first mover advantage and they want to dominate. And only Penn Nat can stand in their way, I think.
Another winner I wanted to highlight this morning with you, Jim, SoFi is up better than 2%. Got an initiation call today at Rosenblatt.
That was
$30 the price target. That's substantial from here because it's at $21.
Look, Anthony Noto is very good. SoFi is an enemy of the JP Morgans of the world. SoFi, PayPal. It's like kind of now it is a trinity, right? It's Square, PayPal, and SoFi. I mean, Noto's injected himself into the debate.
It's the trifecta of kind of pain for Jamie Dimon yesterday, right? Just sort of
the envy.
We didn't get it. We could have gotten it. We didn't get it.
He has tremendous envy for the companies that don't have to play ball with the regulators, don't have to worry about deposits and what the Fed says. Look, Jamie is basically saying we got to play with one hand tied behind our back. These guys can do whatever they want. I think he's right that it's not fair. But you know what? Life's unfair.
So
Fair's got nothing to do. Deserves has got nothing to do with it. Classic line.
Right, but fair doesn't have anything to do with missing the boat. They missed the boat.
He missed the boat.
Said so. He said so. We didn't say so. He said so.
No, you said it.
Shepard Smith
here. I'll also ask you about this. We're obviously waiting on the Fed today. I saw that you were looking at a tweet from Carl Quintanilla this morning by way of Barclays, where they're now saying the market is no longer pricing out of control inflation, which was viewed as a key tail risk for equities. Earnings surprises now likely to continue as consensus EPS expectations are still not fully incorporating the rebasing effect of past surprises. You on the same
I
camp?
think that was an amazing note. I mean, look, I think that with the exception of oil, almost every commodity is peaked. Okay, and now people don't want to believe that, but if you take a look at copper and aluminum, what the Chinese are doing, I really think that the Chinese are trying to get it under control. The one part that we can't seem to cure is freight. There's just not enough drivers. That's something that's structural in the economy. I have Albertsons on tonight. We had to talk about freight being the one thing that they can't seem to get under control. But, almost every commodity, including the grain complex, seems to have peaked. Lumber definitely peaked. So I'm not as concerned either. I thought the note made a lot of sense. I'm glad that Carl tweeted.
Well, so you think it's already moved? Do you think that, because, Paul Tudor Jones says if we don't hear a little bit of foot off the brake today, it is like foot all onto the accelerator if you're an investor in the inflation trade.
Well, look, I think that the steels could work. I remember. Look, Paul Tudor Jones is a giant macro player, and he is not going to analyze whether it's time to buy Cleveland Cliffs or not. He is not going to talk about Freeport. He's got a big overarching view. I think our viewers want to know whether if the Fed says, you know what, it's game on, do you buy the oil stocks? And I think that's true. I think that the oil stocks can go higher. But that has to do with the fact that there is such a scarcity value. I just say, listen, Andrew, oil is the one problem that is very visible. And I think that a lot of the heckling, which is what I regard the questions of the press being, is going to be about oil and inflation. And at some point, if Powell breaks his resolve and says, yes, I'm looking at oil, then the traders will come in like 243 and smash the market. And that's what you have to be aware of. So it's kind of a simplistic day, little binary. Press has to really give Powell a hard time. At one point, Powell maybe slips up and the market goes down big.
Shepard Smith here. Thanks for watching.
Okay, everyone. What's going on? What's up, guys? So, right now there is no news about the Fed, the Fed decision. So what I'm going to do is I'm looking for more videos that are that were just recently uploaded on CNBC from, Jim Cramer, for example, about the FOMC and so on and so forth. So, of course, I found some news. So right here on my chart, I have Bionano Genomics, I have Tesla, I have oil. You guys can easily see it just hit some, resistance. And I have NASDAQ. So we are going to get that decision in the next 15 minutes, I believe. So I'm checking my wire to see if there is any breaking news. Right now, there is nothing. So we just have to wait till the next 15 minutes till, they break this news to us. And that is it for now, guys. I mean, I'm going to, I'll try to keep you guys, alive as as good as possible. So this one, right, this is a news right now that from Forex Live, Yellen, we don't need everyone to go along with global minimum tax for it to be effective. That is something, but it's not related to the FOMC news. So there is another one as well. This one is not this one. I'm going to show you guys another thing from the so this one is from the yield. The treasury yields continue to drift ahead of the Fed. You guys can easily see, because whenever this this 10-year yield is this is the Satan in the room. Okay, whenever this 10-year treasury yields goes up, growth stocks come down. Just like for example, Bionano Genomics. Whenever this thing goes up, growth stocks comes down. I mean, look at it. This is from February. You guys can see 2021, February, March, April, until April. That is when this thing stopped going higher. Okay, this is the 10-year treasury yields. So in March, towards the end of March and the beginning of April, if you guys compare it to the chart of Bionano Genomics, you can easily tell that this thing was affecting the market one way or the other. Let's take a look at it. Beginning of April, okay, beginning of April. Let me switch over to the dailies. I mean, look at that, beginning of April. That's when we got, this consolidation. May 14. Let's take a look at May 14. And of course, this is NASDAQ. Let me see if we can find a better view from NASDAQ. Beginning of April, right here, and then this is the beginning of April. You guys can easily see NASDAQ was also coming down, consolidating, and then bam. So treasury yield, this is the 10-year note. It always affects the growth stock. It affects the stock market, and this title says treasury yields continue to drift ahead of the Fed. So there is no expectation on the supply chain. So the Fed is trying to ignore that. The mark transitory going back to the years, Fed top expectation is to keep level and moment and recent decline. So what I think is going to happen today is they are going to keep the interest rate, they will keep it as it is. That's what I think is going to happen. I don't expect anything crazy to happen, but hopefully they are not going to surprise us with some kind of, increasing the interest rate, for example. I don't think anything crazy is going to happen. So we just have to, you guys have to be aware in the next 12 minutes, that is when they are going to make that decision, and we might see some volatility. You guys can easily see oil is trying to respond, because whenever interest rate is going higher, or all this treasury or whatever commodities, they are performing very well. You can easily see how oil has been performing since the beginning of the year. Oil started 2021 at this level, $47, and right now oil is trading at $72. Okay, so this is why we have to pay attention to all these things. So for example, why I'm making this video is, it's not like I have 1,000 viewers for now. For example, I just have 19 of you amazing people watching this video right now. So the reason why I'm doing this is if you want to invest in BNGO, if you want to average in your position, if you want to initiate a position in Bionano Genomics, maybe we're going to see some kind of spike, and there's a possibility that there's going to be a spike down, for example. So you don't have to panic. That's what I'm trying to say. You don't have to panic. You just have to know what is going on. Okay, that's the purpose of this live streaming. So yeah, you guys can easily see Tesla has also been drifting below since yesterday. Yesterday, investors have been taking money away from Tesla, preparing for what is going to happen today. And right now, this is more or less a consolidation zone. So everyone is more or less waiting for what this Fed, what they are going to say. Okay, the decision that they are going to make on the interest rate. And of course, in the next 40 minutes, there is going to be a Fed meeting in the next 40 minutes. Let me take a look if I can find all these things. If you go to Forex Live on the calendar, you can easily find so this is it, guys. This is it. FOMC economic projection. You guys can see 18 o'clock. I think this is German time. This report released by Federal Reserve includes the FOMC projection for inflation and economic growth over the next 2 years, and more importantly, a breakdown of individual FOMC members' interest rate forecast. So that's why today is a very interesting one in the stock market right now, and most investors are more or less watching this right now. Okay, so I'm going to I want to look for something. I want to see if we can have a live view of this FOMC. I want to see if we can have something from CNBC, for example, so that I can share it with you guys. Okay, FOMC Federal Reserve streamed. Not this one, Federal Reserve. I'm trying to see if I can find a live stream so that I can share it with you guys. And 1 week ago. So there is, I'm right now on the page of Federal Reserve on.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the
What is the Fed? The Fed is simply some group of people messing with the market. So I'm trying to see if I can find this live stream from market coverage. So the only thing we have right now
remote
is
work is not the best option for the bank's employees. We'll be right back.
This one is from Yahoo. Yahoo Finance, but so in the next 9 minutes we are going to get this report. Okay, of course I'm going to be reading it to you guys to let you know what's going on, and then we're going to get the Fed interest rate decision. Then there's going to be FOMC press conference at 18:30. Okay, at in the next 39 minutes there will be the press conference. So in the next 40 minutes, guys, the market should do something crazy. Okay, market should go crazy in the next 40 minutes. Within the next 40 minutes, we should see a lot of action. So this is the Bionano Genomics price action right here. I don't know why this is I'm going to turn it over to 1 hour so that we can see what is going on. You guys can easily see it came down, then now it is retracing back. It's retracing back. 750. Okay. All right, so this is the price action of Bionano Genomics. Of course, it's right now on top of my support level. This is oil. Oil is also going crazy. I don't expect oil to go higher. Okay, oil is super expensive right now, guys. I mean, at $72 US, that is just absolutely insane. It was at 1.72.7 US dollars. So Nasdaq is heading towards it's going down. Nasdaq is correcting. So right here we have Nasdaq, we have Bionano Genomics, we have Tesla here, and we have oil. Okay, so Yahoo Finance. There is nothing yet from now. Once this the Fed meeting is live, I think Yahoo Finance is going to stream it. So I'm going to leave this on this side. Possibly we are going to get something from Yahoo Finance. Let me put a little bit sound so that whenever they go live, we can know what they are doing. So since we still have about 7 minutes, let me share some news with you guys from Bionano Genomics. I already made a video from a breaking news. I made a video a few minutes, like 1 hour ago. I made a video telling you guys about the new analyst coverage. You can easily find it on my channel. Okay, we have a new coverage from BTIG, an analyst, Song Jin Noon, something like that. It's a Chinese name, I think.
Well, if you can go into a restaurant in New York.
So we have a coverage from her, and it's a beautiful news.
From Morgan Stanley CEO James Gorman with some top thought for employees, Jared. Coming as some employees have raised concerns about returning to the bank's headquarters. This message came out earlier this week, but some interesting comments in here. He didn't really mince words. He said, if you want to get paid New York rates, you have to work in New York. And that was directed at a lot of employees, as we know, Jared, that have moved outside of the city during the pandemic. But this is kind of part of that ongoing debate, especially among big banks, about what that post-pandemic workplace is going to look like and whether they should have a little more flexibility on working from home.
Yeah, this is something we all like to talk about, right? It literally affects almost all of us. And this is really interesting, taking kind of a hard line. And I think it's important to point out, as you did, Akiko, that this is a bank. This is a very large bank. Wall Street firms have a little bit of a different corporate work ethic than the rest of us. They work 80 to 100 hours. They're paid millions of dollars a lot of times. Starting salaries start something like 6 figures. And so there are expectations that we own you. And that's basically the message here. I want to read something else he said. By Labor Day, I'll be very disappointed if people haven't found their way into the office, and then we'll have a different kind of conversation. Well, I know if I worked there, I wouldn't want to be having that conversation after Labor Day. But just listening to some of our colleagues talk about this earlier, it was a very heated discussion. And my takeaway is we all have different situations. I personally like working from home in certain regards, but I can't wait to get back to the office, actually stand in front of the Wi-Fi interactive, because that's what it was built for, not to have it on this little tablet before me. So people with kids probably want to get back to the office just so they have a little bit of breathing room. Miles wants to stay home, and that's fine. We're going to figure this out, but this is an evolving process. It's just changing every single day, it seems like.
And you could argue, Jared, employees are in a position of strength right now. We've seen those headlines coming out about a record number of employees quitting in the US, really seeking out that ideal situation for them, because we've learned over the last year that it doesn't have to be all or nothing. It is interesting to see that divide, though, between something like the big banks versus what tech is doing. When you go back to the beginning of the pandemic, it was much easier for tech companies like Microsoft, like Facebook, to transition immediately to work from home, largely because they just need that laptop, and remote work is much easier. You could argue big banks not the same, but there is an argument to be made for people returning to the office, especially when it comes to ideas, exchanging, sort of having that debate. I don't know, I have missed working from the office, especially from the studio, because it is hard to just kind of look at a remote camera in your living room and be able to create the same work environment.
Yeah, nice way to pace reality, because that's exactly what I'm doing right now. I'm literally staring into a camera and listening to your voice and seeing you out of the corner of my eye, just so you get a taste of my setup here. But I think that's a major point. I missed the newsroom. The point of a newsroom is you hear things going on. It's a very live, fluid networking, newsroom. That's what the purpose is for. So I do miss those in-person meetings. I think you get more color when you can look people in the eye and actually kind of see their facial movements. It sounds like a little thing, but we know it means a lot. I think everybody just wants to get back to doing something normal, even if they still want to work from home. All right, after the break, guess what? We're going to talk about more Fed news, because we got that big decision coming up at 2 p.m. We'll talk about that after this.
Okay. Now we have about 2 minutes. I want to read something to you guys, okay? We have about 2 minutes, so let me quickly reduce this, because I found a very interesting thing, what we should be expecting today, okay? So this is an article from Live, of course, Forex Live. You guys can see what to expect from the FOMC today. That is the title. This was written by Gilles Coglan. This guy has been with Forex Live for quite a while now. So the US dollar is in focus. US dollar in focus. Then Bloomberg analysts, they also give their own opinion. Labor targets and risk of overheating, then the takeaway. So now let's quickly start from the beginning. I have about 2 minutes to read this. The bottom line is that no change is expected tonight. Like I have been telling you guys, I hope they are not going to make any changes, because if they make a change, because this is going to affect the economy in the next 2 years. Okay, you guys are in, for example, in America, and of course I'm trading the US stock market. So anything that happens with the US stock market is going to affect my portfolio, for example. So everyone is kind of hoping there's not going to be a change. We are not going to see any changes today. So in terms of interest rates and bond tampering, however, the interesting part of tonight will be on the economic and inflation forecast, along with the interest rate projection. Here is what a survey of 51 economists expect who were surveyed between June 4th and June 10th. So Bloomberg economists, they are expecting greater than half of the economists surveyed expect the Fed's dot plot to show an early lift off for rates in 2023. And 2 out of 5, 40% expect the Fed to take its first step in tampering monthly bond purchases in August at the Jackson Hole Symposium August 26 to August 28. One third expect a tampering announcement in September, and another third say December. So labor targets. The economic survey expect the Fed to be generally upbeat about the robust economic rebound this year. However, bond tapering is expected when unemployment is around 5% and inflation is at 3% as measured by the Personal Consumption Expenditure Price Index. So now let's go down. The April core PCE deflator reading came in at 3.1% year over year, the highest since 1992, but unemployment is still too high. There have been two main reasons that labor supply is weak. Firstly, so now the takedown is the US dollar is trying to bottom, and the Fed should signal. All right, I think.
FOMC meeting, I'm seeing the Dow down about 4 basis points, S&P 500 off just slightly, also about 4 basis points, and then the Nasdaq up 9. And I'll tell you what, we do get some FOMC drift, but not seeing a lot of it today. Well, on the FOMC decision and what to expect from Chair Powell's presser and what he's thinking about ahead, take a drink. And cruise lines are getting an upgrade at Wolf Research after early bookings indications are pointing to a rush back into the high seas in style. Carnival is up about 2.5%, and so is Norwegian Cruise Lines. WrestleMania 37 is coming to Tampa, Florida, with a live audience this time. Stephanie McMahon joins us with Brian Sozzi to talk about how she's building the next generation of that iconic WWE brand. All right, we got to get back to the Fed, and for all things FOMC related, we're going to talk to Craig Fair. He is the Edward Jones Principal and Investment Strategist there. Thanks for joining us, Craig. What are you going to be on alert for? Is this truly going to be the most important meeting of Powell's career, according to Paul Tudor Jones?
Well, you just mentioned your upcoming interview around WrestleMania. I think that's an applicable term for what we're seeing in the markets at the moment as well, which is the market continues to wrestle with this, is it or is it not transitory? That's effectively the phrase that the market's going to continue to grapple with and digest for probably the remainder of this year at a minimum. And so is this meeting important? Yes, not because of the policy decisions that are going to come from it. The Fed will keep rates at zero in terms of the policy rate. The Fed is not likely to announce any meaningful change right now in terms of bond purchases, but the markets are hanging on every word in terms of any signal that the Fed might be digging its heels in on easy policy, despite the fact that inflation readings are running quite high and probably putting a little bit more pressure on the Fed in the transition to a slightly tighter or less accommodative policy starts to get implemented.
What do you think that's actually baked into the market right now in terms of expectations? We had a few guests on yesterday who all said that Jackson Hole is what they're looking to actually get the talking going. Is that already priced in?
If we look at real rates, so if you just look at nominal 10-year rates and back out inflation, they're still deeply negative. And so that would tell me that the market's not particularly pricing in a huge amount of inflation risk at the moment. And I think that probably puts the bias to the upside in terms of nominal rates. Probably not the same magnitude or trajectory of the spike that we saw earlier this year. But I do think that the market is going to have, particularly the bond market's going to have to come to grips with the fact that that inflation is going to stay higher for a while. And our base case view is that it's not going to be fully transitory and we go back to an inflation environment that we saw from 2010 to 2020. We're also not going to, in my opinion, head back into the 1970s, early 80s style inflation environment. I think it's somewhere in between. I think we're going to see the hottest readings on inflation that we've gotten more recently come back down as we move through the summer months and the base effects wear off. But I think we'll settle in at a slightly higher level of inflation. And part of that is because of expectations. Consumers are expecting higher inflation now, and that does have a powerful effect on what actual inflation starts to look like. So in terms of what the market is expecting, I think the market seems to be displaying a bit of complacency at the moment, and that's not fully misplaced. The fundamentals are still quite positive, in my opinion. The path of least resistance over time is probably still higher for equities. But I do think that there's a bit of complacency that suggests that as the Fed starts to, as Jared mentioned before, talk about tapering, I think ultimately that probably injects a bit more volatility into this market.
Oh, Craig, you just had to go there and say that again, right? I want to follow up on inflation here because I think it's really good that you pointed out we do tend to get inflation in waves, and there's different types of price inflation. I think the one we just saw and are seeing now is more based on commodities, and there is some spending that's involved in that too. But what about the wage side? Because when you just mentioned the 70s, we had stagflation, so we had the problem of inflation plus jobs. But when wage growth ramps up and it stays there for a while, we can get sustained inflation. I'm wondering if that's factored into your thinking there at Edward Jones.
Yeah, there's a phrase I've used in the past, which is that somebody has to pay for inflation, meaning that supply and demand curves still matter in terms of where prices go. And Jared, I think you're spot on. There's two elements to this inflation story. One is kind of the core input component of inflation, which is that we know that the pandemic, the global shutdown, created imbalances, disruptions in supply chains. Commodity prices have come roaring back. It's nice to see lumber prices retrenching a little bit. All of that is feeding its way through the system, the production chain, so to speak, and driving higher inflation. That, I think, will start to come back down. We're going to see supply catch back up with roaring demand at the moment. I think that helps rein in inflation on that side. You're raising a critical element that I think speaks specifically to the Fed's role here and what the Fed's likely to do, which is the old adage around the wage price spiral and the Phillips curve. And I think, if we go back to the 70s and look for some keys, back then we had organized labor that was pushing wages sustainably higher in a broad-based kind of bargaining chip type of element. We had the oil embargo that pushed commodity prices, particularly crude oil prices, much higher. Globalization and the supply chains around the world were not quite as fluid. So we've got all those factors today that suggest that we're not going to see that runaway level of inflation. We are seeing a bit of a collective bargaining of the labor force at the moment, which is that we're seeing workers reluctant to come back into the labor force because of a whole host of factors, I suspect, which is partly because of the benefits that are being afforded to them at the moment, and some disruption and some friction in terms of the skills mismatch. I think we'll see that work its way out, but I think wages will settle in, grow at a slower pace moving forward, but settle in at a higher level. So that's where a large part of why we think we'll see inflation come back in from uncomfortably high levels.
There is a breaking news. There is a breaking news that I want to share with you guys.
Experienced during the almost the entirety of the last expansion.
Craig, what does all of this mean from an investment standpoint? Are you putting a little more cash to work? Are you sort of staying put, comfortable in your positions?
We maintain a neutral allocation to equity and fixed income within the relevant asset allocation for each investor. And all that is to say that we think this still remains quite a positive environment for equities. If we think about the fact that every conversation starts and ends with inflation in the market at the moment, equities tend to do well in an inflationary environment. Companies can reprice their sales, which adds to inflation, but also adds to overall revenue growth and profit growth. And I think that will continue to be the case. So we don't have to start to get a little more nervous about equities until the Fed really starts to hit the brakes and ratchet rates up, which is going to be well down the line. We're still a ways away from that. So I still think it's important for investors to maintain an appropriate equity allocation. Our advice to our clients right now is make sure you're focusing on that next layer down in terms of diversification, the sectors that can perform well, the value and cyclical sectors that perform well in this belly of the economic cycle, this stage in the inflationary cycle. So we think there's great opportunities that still exist in the market. Don't forget about bonds, though. As we start to see more volatility in equities, which I think is coming, as we start to see more volatility, even as the bull market progresses, having that allocation to fixed income to protect or buffer against that volatility will be critically important as well. So stay fully invested. However, make sure you're looking underneath the hood for the appropriate amount of diversification in those areas that can perform well in an inflationary environment.
Craig, I kind of like being in the belly of.
All right, guys. So there is a tweet from Bionano Genomics. There is a tweet from Bionano Genomics. So let's quickly check it out before we continue with the FOMC news. Okay. So this one, right? This is a tweet from Bionano Genomics few minutes ago. You guys can see about 20 minutes ago. So they said, I quote, "We are honored to have Dr. Wang Weitao of Curie Institute of France share his research on a high throughput single molecule method. Optical replication mapping." Oh, what is that? Optical replication mapping, guys. This is something new. This is something new. Normally it is OGM, optical genome mapping, but this is optical replication mapping. at the 8th report of CGM EU. Join the Zoom meeting today at 1 p.m. CST to learn more. So join our Cloud HD video meeting. Let me see. Optical replication mapping. That is the first time I'm hearing that, guys. Let me see. Zoom. Optical replication mapping. Whoa. And of course, I have 3 other news I want to share with you guys. So please stay with me. I have one news from Seeking Alpha. I have another news from Investors Place that I would like to share with you guys. So please stay with me. Genome-wide mapping of human DNA replication, optical, replication mapping, DNA replication by optical. Genome-wide mapping of human DNA replication by optical replication mapping supported, blah, 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 optical. So it's more or less a DNA replication mapping. So they just say optical replication mapping. That's a new thing. Now from Zoom launch meeting, I don't know what meeting is this. This is going to be 1 p.m. CST. 1 p.m. CST. All right, so let's go to the next news, guys. Let's go to the second news from this is the breaking news that I was sharing with you guys. But before I continue, let me get rid of this this one from Bionano Genomics, and I can share this one with you guys, okay? So this one is from Seeking Alpha. This is the news they just dropped about a few minutes ago. You guys can see the title says Bionano Genomics expected to generate further upside at BTIG despite 1000% gain. I already shared my own position with you guys. Right now, I am up over 900%, because I started to invest in BNGO from 50 cents, around 50 cent level. So even despite the 1000% gain, BTIG still expects a very solid upside from BNGO. Of course, I already made a video about this, and you guys can easily find it on my channel. The breaking news that I share with you guys, well-detailed breaking news, well-detailed video about BTIG, their initiation of the coverage in BNGO, everything in the, you can find it in the video on my channel. So now it says Bionano Genomics, has risen more than 1000% over the past 12-month period. Yet BTIG analysts led by Songjin Nam anticipate further room for upside as they initiate the coverage of the stock with a buy rating. The price target of $10 per share and implies a premium of approximately 15.6% upside to the last close. So 15%, that is what BTIG. Of course, in my opinion, when Bionano Genomics went down, to that $4.30 level, I believe BTIG used that opportunity to load the heck out of their ship. Okay. But right now, we cannot have any information about what they have been buying. We need to wait till third quarter when they start to file for the second quarter. The form 13F. That's when we're going to know when they bought. At what level they bought, their average price, for example. Their how much, how many shares they bought. How much they threw into the company, and so on and so forth. So stay tuned, guys. Another reason for you to subscribe to my channel. Now it continues. Noting the potential of the company's optical genome mapping technology, the analysts think that Bionano is on the edge of disrupting the cytogenetics testing market, opening a company estimated total addressable market of 700 million to 1 billion US dollars. So according to this analyst, BTIG, they believe Bionano Genomics has a market opportunity, total addressable market of 700 million US dollars, between 700 million US dollars to 1 billion US dollars. But in my opinion, this is more or less a conservative view. Okay, I think this is more or less conservative. And because according to my own model, even according to Bionano Genomics CEO, they believe that their total addressable market is above 2 billion US dollars to that 3-point-something billion US dollars level. So right now the stock the market cap of Bionano Genomics, I believe, is around 2.1, 2.2 or something like that at the moment. So it continues. The large scale structural variations in the genome that are not reliably detected only by the next generation sequencing technologies, but addressed by Bionano's OGM technology, I quote, could become a significant part of the genetic analysis market. Nam and the team argue. Okay, so this is a very nice quote. Could become a significant part of the genetic analysis market. Of course, that's why most of us are into this stock right now, because we believe Bionano Genomics is going to they are going to be the leader in this genomic sector with their optical genome mapping technology. And with the company's recent earnings release, Bionano CFO Chris Stewart commented, I quote, "We anticipate that the strength of our balance sheet will enable us to clear barriers to global adoption of OGM with Sapphire," referring to its research use only platform for social. Of course, Bionano Genomics right now, they have enough cash, 360 something million US dollars. That is a very strong chest. Okay, so before I continue with the next news, let us get back to what is going on right now at Yahoo Finance and see if there is.
Big lift in the session. You see green arrows across the board with Carnival, Royal Caribbean, Norwegian all up nearly 2%. This coming on the back of an upgrade from Wolf Research. That note pointing to early signs of customer demand, more and more travelers considering vacations at sea. The analysts there upgrading Carnival, Royal Caribbean, Norwegian, all to outperform, saying early data points to a strong restart for the industry, and specifically highlighting the bookings improving as well as the price trends in North America. The report saying the unknowns are still, quote, largely transitory when viewed against the broader reopening backdrop. And Wolf Research saying they see the biggest upside for Norwegian, and we're talking about an upside about 16%, Jared.
That's right. And I'll tell you what, I'm interested in this as well. Coming up after this, we're going to talk about Glassdoor releasing its 8th 100 top CEOs as recognized by employees. After this.
All right, so let's go into the okay, now there's a break on Yahoo Finance. So let me quickly share with you guys the second news that I have for you from Investors Place, okay? While we wait. So this one was shared like yesterday. It was shared yesterday by Investors Place, and it says the title says 7 A-rated biotech stocks to buy now. Okay, that's the title. Tech stocks were growth winners in the last decade, but look to biotech stocks for the next upside, I believe. So now these are the lists that they make. Should, in case you guys are wondering where to put your money today, for example, okay, 1, 2, 3, 4, 5, 6, 7. So these are the seven stocks that Investor Place is trying to to suggest to you guys. So this first one is Avid Bioservices Inc., CDMO. BioCryst Pharmaceuticals with the ticker BCRX, and of course Bionano Genomics on the third place with the ticker BNGO. BioNTech, BNTX. Moderna. Yesterday I made a video about Moderna, about the top 3 stocks that can make you richer in 2021, and the first one was Intuitive Surgical. The second one was Bionano Genomics, and the third one was Moderna. So right now, Investor Place is also talking about Moderna. I think I need to look into Moderna, guys, because according to the article from yesterday, Moderna have a lot of things in their pipeline. They have, according to that article, they have about nine, I believe, products in their pipeline, for towards the end of this year. So I'm going to check out Moderna later. So Moderna also made a list of this one with the ticker mRNA, and then there is Vista Gene Therapeutics with the ticker VTG, and I have no idea what this company is. Then there's 22nd Century Group, XXII. So these are the 7 stocks that Investor Place is suggesting that you should, put your money right now. I don't know if you guys are into any of this stock apart from Bionano Genomics. Please let me know in the comment section. Are you guys buying any of this stock right now? Let me know in the comment section, guys. Come on. So the first one is CDMO, and you guys can see with a 295% return so far. Whoa. And BioCryst Pharmaceutical, how many percent? 272% over the past 12 months. 272%. That is the return that investors in this company have gained so far.
Getting high marks from his employees in a recent Glassdoor study. A friend of the show, we should say, Rich, got 99% approval from his employees, followed by Adobe Shantanu Narayan, who also got a 99% approval. To talk more about this study, let's bring in Andrew Chamberlain, Glassdoor chief economist. We've also got Yahoo Finance's Reggie Wade. Andrew, this is an interesting one because it feels like there's so many different factors that could lead to approval of CEOs, and that's really sort of shifted especially during this pandemic. What led to the high marks, and what did you find in terms of what employees really prioritize in the workplace?
Well, in most years, there's three common themes that unite great CEOs. It's being transparent, great communication, walking the walk on company leadership, like embodying the company's mission, and finally, being somebody who puts employees first, being an advocate for workers. This year, though, there was a new factor, which was health and safety. We went through a pandemic, a recession, and a recovery. So more than 56% of these CEOs have never been on our list before. It shows you during a crisis, when people get put under pressure, some new faces shined and came to the top of our list.
Dr. Chamberlain, Reggie Wade here. 29 entrants on the list come from the tech sector. What is it about the tech industry that really lends itself to strong executive leadership?
Well, during the pandemic and with millions of Americans, close to 40–50% of the workforce working from home, tech became part of making that work.
When 501c3 and 501c forms came in that were patently inconsistent with other forms filed with election agencies, both under oath, which would seem to predicate a simple false statement investigation. So again, back to this 501c3, 501c4 mischief, I really hope that you will task some entity within Treasury to report to you and to us on what the heck went wrong and what this miserable decade of what produced this miserable decade of 501c3 and 501c4 abuse.
I understand the importance of this issue, Senator Whitehouse. We really need to get dark money out of politics, and this is an important area. In learning about this issue, I found out how very complicated it has been. And I know, for example, that the IRS has been prohibited from issuing guidance in this area for a number of years. I do believe that this deserves serious study, and I promise to do that.
Thank you very much. And Mr. Chairman, yep, I understand my time is over. I just wanted to add that I think we can solve that rider problem, and I know we intend to.
And Senator Whitehouse, Madam Secretary, apropos of your comment that this is very complicated, Senator Whitehouse has consistently been a voice for transparency and accountability on dark money, and we very much appreciate all his leadership. We're getting close to the Secretary's stop time, but Senator Hassan is here.
Well, thank you so much, Chair Wyden and Ranking Member Crapo, and Secretary Yellen. Thank you so much for a long morning, but a very fruitful one, and we appreciate it very much. I wanted to start to just follow up on a conversation you had earlier this morning with Senator Young concerning the R&D tax bill that he and I are co-sponsoring, which would strengthen R&D tax incentives for startups and innovative American businesses. In your confirmation hearing, we discussed the importance of promoting domestic R&D, which is key for outcompeting China and creating jobs as the economy recovers from COVID-19. Secretary Yellen, will you continue working with this committee to strengthen R&D incentives in the tax code, including by expanding the R&D credit for startups and small businesses?
Certainly, it's a high priority of President Biden. It's a priority in the budget. There are some areas that lack specificity, but where we want to do more to promote R&D, and glad to work with you on this and to discuss the specifics.
Well, thank you so much. I appreciate that, and I look forward to it. Another topic, Secretary, in your confirmation hearing, we also discussed the importance of Treasury programs that combat the financing of terrorist and criminal organizations. I was pleased to see the President's proposed budget included a request for $196 million in funding for the Office of Terrorism and Financial Intelligence, a $10 million increase from last year's funding level. Can you speak to how this increased funding will help Treasury combat terrorist and organized crime financing?
Yes, this is a very important office. It and it's seen a very big increase in its role and mission over the last 5 or 6 years. Among other things, it manages more than 30 sanctions programs, and sanctions have proven a critical national security tool. I think imposing sanctions have advanced U.S. national security and foreign policy interests in areas including counterterrorism, protection of human rights, combating drug trafficking, anti-corruption, and non-proliferation. And the request for additional funds is to support an increase in staffing for OFAC and for IT infrastructure.
Well, thank you for that clarification. And I'm also glad to hear about the IT infrastructure piece, because it's so critically important in Treasury as well as so many other agencies across government. I also want to turn to the issue of unfair trade and supply chains. I was encouraged to see that as part of the President's supply chain review, the administration recommended creating a strike force led by the U.S. Trade Representative that would address unfair trade practices that impact domestic supply chains. In the bipartisan U.S. Innovation and Competition Act, I pushed for a similar amendment. It's now in there, that would strengthen investigations of major trading partners whose unfair practices systemically affect U.S. supply chains and workers. Secretary Yellen, how is the Treasury supporting broader efforts to combat unfair trade practices and strengthen supply chain resiliency?
Well, Senator, immediately upon taking office, the President directed a whole of government effort to shore up our supply chains, and addressing unfair trade practices is a key component of that work. We welcome fair competition from abroad, but in too many circumstances, unfair foreign subsidies and trade practices have adversely affected U.S. competitiveness and impacted manufacturing unfairly. So the administration is really implementing a comprehensive strategy to push back on unfair competition that erodes the resilience of our supply chains and industries. And this strike force that you described will be led by USTR, and it's one element of the strategy. Its goal will be to identify unfair trade practices that have eroded U.S. critical supply chains, and they will recommend trade actions to address these practices.
Thank you so much, Secretary. Thank you, Mr. Chair. I'll submit one more question for the record about implementing the employee retention tax credit for businesses that started up during the pandemic.
I very much appreciate my colleagues' work on that employee retention tax credit within the first package. Thank you.
Thank you.
Senator Toomey's back.
Thank you very much, Mr. Chairman. Welcome back, Secretary Yellen. I have to say, and I think this will not come as a surprise to you, I'm just extremely disappointed by this entire process that you and your colleagues have engaged in with the G7. This idea that countries that are pursuing greater economic freedom and the prosperity that comes from it, that constitutes a race to the bottom, I think couldn't be a worse way to think about this. Expanding economic freedom, diminishing the burden countries put on their businesses, their economies, their opportunities for growth. That's not a race to the bottom that we should try to prevent. That's a race we ought to be winning. And I just completely disagree. And by the way, I think everybody has to acknowledge that there's an implicit confession in this whole effort, which is that the Biden proposals with respect to tax reform make America less competitive. And that's why we need these other countries to inflict the same kind of damage on their economies that he is suggesting we do to ours. I think it's completely misguided, I have to say. Let me get to one of the specifics. You know very well, and we all remember that prior to the TCJA, U.S. multinationals had a significant incentive to establish their headquarters in some other country, almost any other country, at least from a tax point of view, because we had such an onerous tax regime on the income earned overseas, especially if you wanted to bring it back home. We addressed this head on. We made significant changes to deal with this. And I haven't been able to identify a single corporate inversion of a major American company since the enactment of TCJA. And so maybe I missed something. Secretary Yellen, are you aware of a single corporate inversion of a significant large American multinational post 2017 tax reform?
Well, what we're concerned with is shifting of profits to tax havens, where the United States loses the ability to gain the tax revenue, and competition from firms in other countries that make use of tax havens. More broadly, we do have to raise tax revenue in order to be able to finance important expenditures that make us more productive.
Madam Secretary, I really hate to rudely interrupt, but I've just got so little time. And so I know you want to raise taxes and the president wants to raise taxes, but rather than get into a general debate about that, I do want to, I'd like to exchange some data with you. The data that I've looked at suggests that there has been no shifting of American corporate earnings to lower tax jurisdictions. When I asked, are you aware of an inversion that has happened since 2017, you kind of shifted to a different question, which is a concern about income shifting. I'm still not aware of a single corporate inversion that has happened since we eliminated the incentive to invert. And yet, we have in the Biden proposal something called the SHIELD, which is an acronym for Stopping Harmful Inversions and Ending Low Tax Developments. I don't know why you have to do something to stop inversions that are not occurring. I would also point out that we have a global minimum tax. We have GILTI, and most of the rest of the world doesn't, but we've got it low enough that it isn't a prohibitive problem. The administration is now proposing doubling the rate to 21%. But earlier, you told Senator Crapo, I heard you earlier in this hearing, and I thought I understood you to say that the administration's proposed effective GILTI rate is 21%. But as you know, the existing tax law disallows taking full credit for all of the overseas taxes paid, and that increases the effective rate from the statutory 10 to about 13 1/8. If you raise that to 21, unless you allow full credits for which current statute doesn't, the effective rate will be 26 1/4. So my question for you is, are you contemplating allowing the full crediting of foreign taxes paid rather than the partial crediting that occurs under the current law?
I'll get back to you on that, but I believe we haven't changed that.
I thank my colleague from Pennsylvania. We've got two other senators waiting in the queue. I believe Senator Daines is first, then Senator Barrasso, but we're going to get you both in, and we can do it before the sand is out of the hourglass and the secretary has to leave. Senator Daines.
Mr. Chairman, thank you, and thanks Secretary Yellen for being here. Secretary Yellen, I sent you a letter yesterday. You probably haven't had a chance to read it yet. So I'd like to ask for unanimous consent to submit it for the record, Mr. Chairman.
Madam Secretary, just so the record's clear, without objection, it is so ordered.
And it's on the topic of cybersecurity, something I'm hearing frequently from Montanans and business owners across our country who are worried about the major upticks in cyber attacks and ransomware payments that we've seen recently. That attack on the Colonial Pipeline controls nearly half of the gasoline, jet fuel, diesel flowing along the East Coast. Should serve as a wake-up call for our country. And of course, we saw the same with this attack on our food supply chain as well, most likely Russian cyber attacks. The financial system facilitates commerce in every industry, and an attack of a similar magnitude we saw on Treasury or a major financial institution could cripple the financial system as well as our economy. Secretary Yellen, at the most recent Financial Stability Oversight Council meeting just last Friday, the 11th of June, you outlined three key priorities. One, vulnerabilities in non-bank financial intermediation. Two, climate change. Three, Treasury market resilience. I'm concerned that Treasury's focus on longer-term risks associated with climate change is coming at the expense of the major threat, the immediate threats we're seeing from cyber attacks and ransomware attacks that we're seeing nearly on a daily basis. The question is, do you really believe that cybersecurity of our critical financial infrastructure, even after the recent surge in attacks, is still not a top three priority for the FOMC?
It's a huge priority, Senator Daines. It is a great threat to financial stability. Treasury has long taken the lead in trying to pull together the financial sector to exchange information and to raise preparedness. It has groups fondly known as FIBIC and FISIC that are organized to address financial sector threats. It is one of the most important focuses these days in supervision of banking organizations. The FFIEC, which is the group of federal bank regulators, has a comprehensive program. It's an
Secretary Yellen, thank you. We've spent, both of us, years in managing large organizations, and at the end of the day, it's a zero-sum game. And priorities say this is most important, and I just would hope that what's going on right now with the cyber attack, something truly could bring down the entire financial system of the United States government, would rise to a top three issue, because everything can't be the most important thing. And I'm just concerned climate change is a longer term issue. We've got some very acute challenges today that could literally bring down the financial system of the US government and our country. So I've got a couple of questions. I want to go back to the G7 and the recent agreement into a global minimum corporate tax rate of 15%. I think a bigger test is going to come with the G20 next month, which includes China, of course. It's clear that China does not have the best record of living up to its commitments, whether we're talking about a session in the WTO or otherwise. Secretary Yellen, will you commit to not agree to any deal that includes special carve-outs for China or any other country? And what steps would you take to ensure that if China does agree to a deal, it's held accountable and fulfills their commitments?
We would not agree to any type of carve-out that would meaningfully weaken a robust global minimum tax regime, not for China and not for other countries. We want this to work and not be filled with loopholes. We continue to work to try to bring China into this agreement. Other countries are doing the same. We'll see where we are when we get to Venice in a couple of weeks for the G20 meetings. I'm hopeful China will decide it's in their interest to join this agreement, but I do pledge that this is not an agreement that we will weaken.
The time of my colleague has expired. We've got Senator Barrasso next. Madam Secretary, we're going to have Senator Barrasso take his 5 minutes. The floor is waiting for me. We will have you out within 3 or 4 minutes of your hard stop, and I'll be back to wrap up. Okay, Senator Barrasso.
Thanks, Mr. Chairman. Thank you very much, Madam Secretary. Thanks for testifying before the committee. Your budget request is for about 11.3% increase from fiscal year 2021 in the department's budget. Includes about a 10.4% increase in the IRS budget. This includes $5.5 billion in the enforcement account to hire more compliant staff. In my experience, the overwhelming majority of Americans and people in Wyoming are trying to pay the correct amount of taxes that they owe. The tax code is complex, and dealing with the IRS, I know for people at home, can be intimidating, it can be confusing, it can be stressful, and it can be never ending. Thankfully for many, we have taxpayer advocacy and a taxpayer advocate service. I think it's a very important tool that the IRS has to help taxpayers. The taxpayer advocate, and I meet with them in Wyoming, they don't have the resources or the authority to resolve every problem that taxpayers encounter with the IRS. The issues that they can help with are limited, but their assistance and guidance can really be invaluable. I've heard that from folks at home. Given the focus on enforcement in the budget, can you detail to me how the Treasury Department and the IRS are going to enhance the visibility of the taxpayer advocate and ensure that the resources are available to help people receive answers to questions and provide guidance to so many Americans who are just simply trying to correctly follow the law?
Well, I agree. Taxpayer service generally is not what any of us should want it to be at the IRS. And this is partly due to lack of resources, the decrease over the last decade of about 20% in real terms of resources. And more recently, the pandemic has made, put special strains on the IRS. But the funding that we're seeking for IRS in the budget, you mentioned the importance of compliance. I've emphasized that. But customer service, broadly speaking, is also important. And that would be an important thing that we would want to see greatly improved.
Well, thank you. I agree with you. I think it'd be very helpful to the taxpayers who are trying to comply, trying to follow the law, trying to get it right. And sometimes they just need a little assistance, and the taxpayer advocacy group does do that. I wanted to move to the budget singling out producers of oil and gas products by disallowing them from using certain tax provisions, such as intangible drilling costs and percentage depletion. That proposal will almost certainly raise gas prices at the pump. It'll affect working Americans, leading to a violation of the president's promise. He said he wasn't going to raise taxes on anyone earning less than $400,000. So at the same time, in some of the infrastructure spending discussions with Congress, administration has rejected even indexing the gas tax because, and the president told us that when we were in the Oval Office meeting with him, he said, no, indexing the gas tax or raising the gas tax would certainly raise gas prices at the pump that would affect working Americans and violate the president's tax pledge. But what you're proposing in the budget is certainly going to raise the cost at the pump. So it seems to me that the two positions are inconsistent. The president is saying he doesn't want gas prices to go up by adding taxes, but he is willing to let the gas tax prices go up by taking away some of the deductions that exist right now for those people who produce America's energy.
The president is very concerned, as most countries around the world are, about climate change and sees no policy justification for subsidizing fossil fuels. He really believes that inefficient subsidies for this industry can reduce more efficient investment elsewhere in the economy. And he wants to see the United States become a global leader in clean energy and to see an increase in really good jobs in a rapidly growing sector. His proposal includes subsidies for green energy production, and will create jobs in a new and expanding sector. With respect to price increases, I've looked at some recent studies on what the impact would be of phasing out fossil fuel subsidies. And generally, although there might be some positive impact, the impacts are generally found to be small.
Yeah, well, I appreciate your comments. It looks like time has expired for me. I don't see the chairman back yet, but I would point out that until I know he'll be back to adjourn. If he shows up, I'll stop immediately. That we're facing a $27 trillion debt. The budget requests $1 billion for the International Climate Change Fund. It's an increase of almost 786% over funding from last year, happening at a time when American people are facing significant challenges at home, communities across our nation, emerging from the pandemic. dealing with the soaring debt, declining infrastructure, whether it's the Green New Deal or the UN climate change slush fund. I think the American people can't afford these kind of policies. And why should taxpayers support borrowing more money from countries like China in order to send it overseas to international bureaucrats in the name of climate change? I don't get that at all.
Well, climate change is a global threat, and while we need to make meaningful reductions on our own, our efforts won't be successful at addressing the climate threat unless we see similar efforts around the world. And the United States committed as part of its Paris Agreement to help provide funds for developing countries, for low-income countries, to reduce their climate emissions and to address the impacts of climate change. And we've upped our contributions to the Green Climate Fund in order to make good on that commitment, which is a very important one.
Well, thank you very much, Madam Secretary. I see that the chairman has not yet returned from the vote. I know you have a hard stop at 45 minutes after the hour. It's now 44 minutes after the hour. I don't know if I'm entitled to adjourn the meeting, but if he doesn't come in within the 1 minute, I would be happy to adjourn the meeting because I know you have places to be and commitments to meet.
Thanks so much.
Thank you.
Much appreciated. Thank you, Senator.
Thank you, Madam Chair, Madam Secretary.
So that is it, guys. So we have about 1 hour, 15 minutes left to, so you guys ask some questions and I'm gonna answer some of your questions, okay, before we continue to the next one. We have about 1 hour, 15 minutes left to the Fed decision on interest rates, you know. And so let me quickly check out you guys' question. I'm going to close this. So somebody is asking me, Justin asks, if you had 4,000, what would you be your play when the Fed news breaks? So the idea is whenever the news, you know, you buy the rumor, you sell the news. That is mostly the idea of trading. If you want to trade it, of course, I'm an investor. I'm not a day trader, okay? But I have some trades open right now on this. Right now, I'm trading oil. You guys can easily see I'm shorting oil from this zone. And I'm just watching NASDAQ because NASDAQ is going to show you what is going on in the entire market. You guys can see, let me put 15 minutes on the NASDAQ chart so that you guys can see it clearly. You guys can easily see NASDAQ has been going down since we started this live stream, okay? And of course, you can see Bionano Genomics, because this station is more or less about, you know, Bionano Genomics. You guys can also see that Bionano Genomics has been, you know, giving back most of the gain that it has gained today. And Tesla has more or less not been doing anything. So right here, if you want to trade this kind of news, you have to trade commodity, for example, or indexes like NASDAQ or oil. So if the news breaks out, according to your question, this is how I would do it. If the news breaks out and it is positive, okay, if the news is good for the market, of course, hopefully these whales, you know, big hedge funds and so on and so forth, hopefully they are not going to, you know, trade it before they break out the news, because sometimes the news is leaking and the trade is happening before even the news, you know, gets broken. So now this is a good buy zone right now. You guys can easily see right at 13,980 for NASDAQ. That's a good buy zone right now. Okay, so if the news breaks out and we see this support level holding, then it is a buy. Okay, then you know it can go higher. So if the news is positive for the market, let's say they don't do anything with the interest rate, they leave it at 0.25%, then the price should keep going higher, because right now more or less NASDAQ is trading at all-time high. So it means it will keep going higher. But if it is a bad news, if they increase the interest rate, then NASDAQ is going to drop like a stone. Okay, I mean, I'm talking about serious drop in like 500 points. Okay, so that's how you trade it. So for oil, for example, if they increase interest rate, oil will keep going higher. We may see oil at $75 even today, or even at $80. Nobody knows. But if the news is positive and if they don't do anything with the interest rate, if they leave it like it is, oil will keep going down. I mean, oil is super expensive right now, okay? So for stocks like Bionano Genomics or Tesla, for example, I expect if the news is positive, if there is no changes in the interest rate, I expect Tesla to go back up above $600 level. And of course, Bionano Genomics, there are tons of good news. Yesterday we saw a massive, a good bullish catalyst. 2 days ago there was a good news, and today there is a new analyst coverage of Bionano Genomics with a price target of $10. So if this news is good, you guys should be expecting, a solid run up for Bionano. We may see BNGO maybe tomorrow or next tomorrow at $9, for example. So that's how I would trade this. Okay, I hope I have been able to answer your question correctly. So let's check out what is going on with at Yahoo Finance. I still have some information that I want to share with you guys, but no need to rush. I mean, it's just we still have about 1 hour 10 minutes left till the FOMC and the Fed rate decision. So we still have enough time, guys. So chill out.
Realize that there was a lot of duplication and inefficiencies. So it's really just being more prudent business people and looking at our business in a different way.
Well, before I let you go, I had to ask you from a fan perspective, what are you going back in the ring? I haven't seen a match with you in that ring since WrestleMania 34. Give it to us straight.
Since Ronda, I think ever since Ronda Rousey broke my arm, I have a little PTSD. So I'm not sure when you're going to see me in the ring anytime soon, but I guarantee for SummerSlam, there's going to be a lot of surprises.
Okay, well, hopefully maybe one of them is, in fact, you back in the ring. We will leave it there for right now. Good luck on the return to live touring. WWE Chief Brand Officer, Stephanie McMahon. Good to see you.
Thank you.
And we'll be right back.
Okay, so let's continue with the breaking news that I was sharing with you guys before. Okay, so guys, you can easily see that oil, where is it? All the commodities are more or less up today. Okay, if nothing change, if the Fed if they leave the interest rate like it is, okay, at 0.25%, commodities will go down. Okay, I don't know about gold, but I believe oil is going to go down. That's what I'm trading today, guys. That is what I am trading, oil. So you guys may want to keep an eye on oil. Let me increase this size a little bit so that we can see it clearly. This is NASDAQ right here on 1 hour chart. NASDAQ. In the next 1 hour, there's going to be the meeting. So you may want to, if you are presently trading oil or gold, or if you want to add to your position of Bionano Genomics, for example, or you want to, add to your position of Tesla, it is a good idea to wait until after the decision. It's always good to wait because sometimes the decision is positive, but the market is going to react negative. And sometimes the decision is negative, market is going to react positive. And if, let's say, for example, let me give you an example. Let's say the decision is positive for the market and oil goes up, okay? Because normally if the decision is positive, oil is supposed to go down, okay? So let's say the decision is positive and oil goes back to this level, $72.55 US. You should know that you have to short it, okay? You have to sell the rip. So let's say the decision is negative and oil goes down, then you might want to get out of your position. Let's say you are shorting oil, you may use that opportunity to get out of your position and open a buy position, for example. I'm not an investment advisor, guys, so don't sue me, bro. I'm just here to, tell you guys what I believe is going to, happen to the market. So I'm going to switch this over to 15 minutes so that we can see what is going on clearly. And now this is a news from Investors Place. We didn't finish the news. So this news is, like I was telling you guys, this news says 7A rated biotech stocks to buy now. And the first one, of course, is Avid Biosciences, Bioservices Inc., CDMO, BioCraze Pharmaceutical, BCRX.
I'm Jared Blickery. It is time now for our hot takes, and we're going to be talking about Lena Khan. She was just sworn in as a chair of the Federal Trade Commission on Tuesday, and a very vocal tech critic. She came on the scene, really got to prominence by writing something called the Amazon's Antitrust Paradox. That was for Yale Law Review in 2017, and it became a blueprint for how the federal regulators, both at the FTC and also at the DOJ, would come to investigate companies for antitrust based on a novel theory. And that has to do with something like Amazon using their customers' data, or excuse me, using their partner data, people who sell Amazon products on Amazon to other people, their customers, basically using the data to gain a competitive edge. And I'll tell you what, she was in the House when they were investigating all the big tech giants, including Alphabet, Amazon, Google, and she's going to potentially be signing off on new FTC probes on some of these very same companies. And that has generated a little bit of controversy, but also Akiko, she's 32, youngest chair, forget chair, she's the youngest commissioner ever at the FTC. That's quite a remarkable accomplishment.
Yeah, and Jared, you were talking about that paper that she wrote, laying out how these antitrust laws that are currently in place have really failed to keep those like Amazon and its power in check. Well, she wrote that when she was a student at Yale. So it's been a fast rise for Lina Khan, and to your point, 32 years old, the youngest to serve as FTC chairwoman.
Guys, take a look at the stock market. This is the situation of the stock market right now. Most of them are, mixed right now. You can easily see, financials, everything is more or less mixed right now. You would expect financials, for example, was green. Okay. You would expect energy sector to be completely green. And industrial, for example, you would expect them to be completely green. As you guys can see, they are all waiting for the FOMC Fed rate decision. That's what the whole entire market is waiting for. So we just have, all these whales like Amazon, Microsoft, and Apple, because they are safer bets. So mostly you guys can see that they are green. But all these risky assets like, all these super volatile stocks like Tesla, for example, is down. NEO, look at NEO. NEO is down minus 2.48%. And software, you guys can see SAP, Snow, Nvidia, for example, they are all waiting. Facebook, Google, those are the risky ones. Okay, Microsoft, Apple, Amazon are the safest bets whenever it comes to technological stock or consumer electronics or consumer cyclical. So the market is more or less waiting for the Fed decision, and it's going to be in the next 1 hour 4 minutes. So I hope I'm going to have enough energy to stay live, and we can check out what the market is going to, what the reaction of the market is going to be once the decision has been made. So yeah.
It's not only the FTC that regulates antitrust, it's also the DOJ, and which is kind of a unique circumstance. I'm not aware if this exists elsewhere in the world. They share responsibility. They kind of tag team for the smaller companies. One will take one company, one will take the other. As I understand it, they're collaborating on these giant tech behemoths. But you got to think here, Akiko, that at the end of the day, this is going to be a very long, drawn-out process, and it's probably going to be years before we see any kind of action here. So we'll definitely be keeping an eye on this for everyone. And it looks like we're running out of time right now, Akiko. These 2 hours just fly by with you, and we're going to be up after the break for the 2 p.m. hour with Alexis and Kristen right here on Yahoo Finance.
Okay, guys, so all right, so let's continue with the news I was reading to you guys. So I have something that I would like to share with you guys once again. And the US stock open, stocks open with mixed results, just like I showed you guys from the stock market map. The FOMC rate decision is what most investors are waiting for right now. So for Bionano Genomics, if the result is positive, guys, if this result is positive, I expect BNGO to continue going higher, because from last week Friday, on Monday, and yesterday, there was positive catalyst for the stock. Okay, BNGO. We had several positive catalysts. We have the appointment of the chief business officer. We have the appointment of the chief commercial officer, and now today we have this coverage analyst, new analyst. It's opening a coverage in Bionano Genomics. So that's what most investors are waiting for right now. You guys can see the FOMC rate decision is being waited for, and this one is the result of oil, crude oil today, gasoline distillation cushion for you guys that are trading oil. Okay, and this is the normal, the US 2 years, US 5 year, 10 year, and 30 years yields. So that's what we are waiting for, guys. We just have to keep waiting till the next 1 hour. We have 1 hour left to this Fed decision. So if you guys have any question, please drop it in the comment section, and of course I can quickly attend to you. Okay. Tesla is back above $600, guys. Tesla is back above 600. I don't expect oil to go higher than, I mean, why would oil be at $72? Okay, why would oil be? This thing was trading at $7 almost a year ago, $7. So why would it be at $72? This is a long-term short position for me. I initiated position in oil. Normally you won't see me trading oil. Okay, I mean, I stopped trading oil about 3 or 4 months ago when it was only going higher. So I was waiting for it to go above $70. So now I have initiated a position in oil, a short position, of course. So
welcome into the 1 p.m. hour here on Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous, and here is what is happening today. We are waiting for guidance and direction from the Federal Reserve today. Fed Chair Jay Powell will be speaking in a press conference at 2:30 p.m., while the Fed's monetary policy decision is going to be coming down at the start of the next hour. Now, no major policy moves are expected, but investors are waiting for signals from the central bank on tapering of asset purchases. We'll be chatting about that over the course of the next 2 hours. And many people that have recovered from a coronavirus infection are now saying that they are experiencing lots of new health problems, even if they were asymptomatic or they experienced only mild symptoms. Some of those new health issues include breathing problems and fatigue. We'll be discussing that with the doctor a little bit later on this hour. And a new progressive tech critic has been named the chair of the FTC. We have Congresswoman Chair Powell joining us today to discuss that appointment, as well as a spate of antitrust legislation that is being aimed at big tech. But first, a look at the markets right now, where Alexis, it seems we have all 3 major indices in the red. Equities seem to be waiting for some kind of direction right now from the Federal Reserve.
For sure, Kristen, we are in this holding pattern, I guess you could say. We've got the S&P and NASDAQ pulling back from those recent highs. They're down just modestly now, the S&P off 9 and the NASDAQ pulling back about 15, but the Dow Industrials are now down nearly 100 points, all waiting for the conclusion of the Fed's latest monetary policy meeting. And we know this comes at a critical juncture for our economic recovery. We have a situation where we're having rising inflationary pressures. And so some experts are saying the Fed should probably make a move sooner rather than later when it comes to tapering its asset purchases and raising interest rates. We're going to find out a whole lot more at the top of the 2 o'clock when that meeting concludes. Want to take a look now at some of the movers today in terms of sectors, the winners and the losers. As you can see here, we have got our real estate slightly on the upside, healthcare as well, but there is more green today, or more red, I should say, than green. Some of the biggest losers, financials, makes a lot of sense as we await more clarity from the Federal Reserve and sort of the direction of interest rates in the short term, at least. We've also got industrials lower and communication services. Let's take a look at the bond market quick ahead of that Federal Reserve meeting, because we've got Treasury yields. They've been mostly lower, and right now we've got the benchmark 10-year yield hovering right around 1.49%. Let's get to some stocks that are trending on our Yahoo Finance site today. And we're going to start with Oracle, out with earnings. It earned $1.54 a share in the latest quarter. That beat consensus estimates, and the business software company's revenue also topped estimates. But what's getting investors down is their forecast for the current quarter, a profit forecast there coming in below estimates as it increases its investment in cloud computing operations. So the stock is now down more than 5%. Roblox is the #1 trending ticker on our site right now, and it is down more than 8%. That's because the company said it had 43 million daily active users for May, up 28% compared to a year earlier. but it was down from 43.3 million in April. Spending by users of the video game platform was down slightly as well from a year earlier. And Coca-Cola, sort of the water cooler talk of the last couple of days, still losing ground there after a snub from Portugal's soccer star Cristiano Ronaldo this week. Wiped out, get this, $4 billion in Coke's market cap this week. You may have seen that press conference video from it where Ronaldo had two glass Coca-Cola bottles in front of him and he sort of slid them away during a press conference. And instead, the health-conscious athlete held up a bottle of water and said, agua. Coke is one of the Euro 2020 tournament's official sponsors. Took a definite hit, I guess, Kristen, of the power of athletes there, right? And as influencers taking hold there for Coca-Cola. All right, let's get back to let's bring in Brian Chung now to talk more about the Federal Reserve and this meeting. What are you expecting to hear from Fed Chair Powell during that press conference that's going to kick off at 2:30, Brian?
Well, Alexis, a lot of anticipation for this particular meeting because of the inflation data that we've received since the Fed's last meeting at the end of April. You will recall that we got a number of estimate beating reports on the CPI, on the PCE, in addition to, even as of this week, the PPI. And for anyone lost in the alphabet soup, basically all you need to know is that prices are rising. So the question for the Federal Reserve is, are prices rising at a clip that might concern policymakers, that these things aren't transitory, as the Fed has messaged, that maybe these are things that could be a bit more deeply rooted, things that aren't just due to supply chain disruptions. We've heard that argument from the likes of Philadelphia Fed President Patrick Harker, Dallas Fed President Robert Kaplan, in addition to even one Fed governor down in DC from Randy Quarles. But it seems like the majority of the 18-member FOMC is still very much in team transitory as opposed to team overheating, saying that inflation right now isn't necessarily a cause for concern, even though some of those readings might be clocking in higher than the Fed's 2% target. But of course, very interesting to see where we might see the dot plots. Keep in mind, this is kind of the map, if you will, of where policymakers could see interest rates going in the next few years. And I believe we have a full screen of what the dot plots look like in March of 2021, because again, the Fed only releases these on a quarterly schedule. You can see ahead of you that when you look at 2023, if you look at the median dot among those 18 voting, or rather the 18 members of the committee, the median dot would be at the zero range. So basically no rate hikes through the end of 2023, even though of course you can count the 7 members of the FOMC that see at least one rate hike through that horizon. So one major question as we head into this meeting this afternoon is, could the refreshed version of this dot plot, which we'll get in about 55 minutes, show that median dot may be rising? And the way that would happen is if 3 of those people at the bottom range end up revising up their estimates for where interest rates could be. If that does happen, which again, not necessarily a certainty, but if that does happen, what do bond markets do? That could be a scenario where there might be some sort of taper tantrum, maybe not all be at the same level of 2013, but a surprise that could be on the hawkish side. So very interesting and worth watching. And of course, statement comes out at 2 p.m. I'll be on the show wearing a blazer when that announcement comes out, in addition to the press conference, which will go live at 2:30.
I don't know why you didn't want to dust off that blazer for us in the 1 p.m. hour, Brian. I'm a little bit offended by that, but we will see you right at 2 p.m. to break down that decision from the Fed. Thanks so much. And I want to turn now to Brent Schutte, Chief Investment Strategist at Northwestern Mutual Wealth Management, for what we can expect from the Fed a little bit later throughout this show. So, Brent, I want to start with what you are expecting from the Fed today, and particularly just on what Brian was hinting at about those movement in that dot plot. Are you anticipating that there could be some movement, at least in where they see interest rates going?
Potentially, but I think the bigger thing here, and the phrase that I keep hearing from the Fed, is outcome-based, not outlook-based. And so I know there's a focus on inflation right now. The Fed believes that's transitory, as do I. The bigger focus for the Fed is on the labor market. And you still have around 12 million people. So you had people drop out of the labor force, and you still have less people employed pre-COVID that they want to bring back into the labor force before they begin doing anything. Now, that all being said, I do think they want to avoid a taper tantrum. So perhaps they advance the ball just a bit, but not much. And so all in all, I don't expect much new news. And certainly what I do want investors to remember is that there is a big difference between the Fed beginning tapering and the Fed tightening the economy into a recession. As an investor, you're going to need to ignore the noise that comes out over the coming quarters as the Fed tapers, because that may cause a near-term correction, but it certainly won't cause a recession. And recessions cause big stock market downturns, not corrections, or not non-recessionary corrections, I should say. And so keep your eye on the ball, stay invested, and ignore the noise.
Okay, maybe a little easier said than done, Brent, but what are you doing in terms of having a defensive portfolio in this environment with so much uncertainty? I mean, inflation is here at the moment, whether it's transitory is still to be seen. So are you making some moves in that portfolio right now? And can you share those with us?
It's way too early to be defensive. If you think about it, growth in the US hasn't even peaked. Typically, you start thinking about becoming defensive when growth peaks. And based upon the ISM surveys, so you have a lot of new orders coming into factories, you have huge backlogs, you have low inventories. We haven't even seen peak growth yet, and the Fed hasn't even tightened for the first time yet. And so I would advise people to stay more invested towards cyclicals. And if you want, and I think you should, begin thinking more about international equities, specifically the Eurozone, where their recovery is just beginning. They're actually coming out of a double dip recession. They actually had negative GDP growth in the first quarter, and you're going to see positive in the coming quarters because they're having increased vaccinations. They are beginning to reopen, and you're going to see earnings growth there that is similar to what the US just had. And that, I think, will attract investors' attention as this US recovery becomes much more global. And certainly the Eurozone is leveraged to a global recovery.
I want to ask about the taper tantrum. I can't remember now who said it to us. Alexis, you might remember. But we were essentially told that the taper tantrum they believed had already actually happened. Curious to know if you agree with that point of view. And if not, what we can expect going forward then.
Perhaps you could say that because you did see a spike in bond yields, which caused some of the quote unquote froth to come out in some of the stocks that are based upon hopes, dreams, and themes, which I think, again, will probably be under pressure just a bit as we do have the Fed start talking about tapering.
He was going to
but
not
I do
let
think
this
there's
moment.
potential for more. But keep in mind, the Fed is going to try to do everything they possibly can to avoid that. They've studied that. They look at investor behavior. They'll probably test and probe a bit. Powell may do so today. And then they'll have speakers come out over the next few weeks and walk it back if there's damage repair need to be done. Because the one thing that I know about the Fed is that they typically don't like to cause big market disruptions during the day when they're talking. And typically, if they do, they will walk it back. And I remind you once again, the Fed needs the stock market to remain strong because the way the Fed impacts the economy today is, quite frankly, through the bond market, which has an indirect impact on the stock market. And if the stock market
looks
falls,
like Jim Cramer is back.
Want to step away from the Fed for a moment and talk about some housing news we got today that I found pretty startling, Brent. Apparently, according to the National Association of Realtors, the U.S. needs 5.5 million more units to ease the housing supply crunch we're seeing right now. Yesterday, we had on the CEO of the National Home Builders Association talking about home builder confidence now being at a 10-month low. Home builders are having a tough time getting loans as raw material costs continue to rise. Could, ironically, the booming housing market be the thing that might trip up the economic recovery in the coming months?
I don't think so. I mean, you can view that as good news or bad news. I mean, the good news side is that we need more houses built, which actually has an economic multiplier to it. I think in the near term, the bigger concern that I had was on the inflation side. And I think actually the quote unquote disappointing home news, which is still pretty good because it's still at pretty high levels, is that people aren't going to create some sort of price spiral, I don't believe. And so if you look at the University of Michigan last week, people said it wasn't a good time to buy a home because of rising prices. Now that may sound bad, but if inflation is your primary worry, that means that people are not going to cause that price spiral by actually outbidding each other. And I know some of that's going on, but I do think people are still remaining sensitive to prices, which means to me that inflation will likely be transitory in the near term because a big part of inflation is not only supply versus demand, but also people's expectations. And right now, people seem to be a bit more sensitive to rising prices, which actually should keep inflation at bay.
All right, Brent Schutte from Northwestern Mutual Wealth Management, thanks as always for joining us today. And coming up next after the break, President Biden is meeting with Russia's Vladimir Putin. We'll be bringing you the details of that meeting next.
Back on the AMC train, boys and girls.
This is Clay for Finance News, but before we get into the video, please smash that thumbs up button for me and subscribe to the channel. It really helps us spread the truth about AMC. Okay, let's jump into it. At Jim Cramer tweeted, AMC, a true horse. Cramer seems to have jumped back on the AMC train, but here is what he thinks of other meme stocks. This article is courtesy of The Street. Do people who create and push meme stocks know that they may be sticking it to the man, but they are actually sticking it to themselves? This morning, I saw a post on Wall Street Bets babbling about Corsair Gaming, a high-end, mostly gaming equipment company, and I said to myself, here we go again. Corsair's stock will jump 8 or 9 points, and then the hedge funds will come in and short the stock and make a killing at the memist's expense. Who can blame the shorts? As much as I like Corsair, as much as I have championed it, with the exception of GameStop and AMC, stocks.
Oh my God.
Leave
Oh
inflation
my God.
out of control. He wants to keep rates low so that the unemployed, I think Powell's very committed to an easy course, even if you believe inflation's out of control. He wants to keep rates low so that the unemployed and the disenfranchised get decent jobs. If the cost of a stronger labor market is above average inflation, so be it. Whether you agree with Powell or not, he's been very upfront that this is the plan. So I'm willing to wade into the beaten down industrial aisle and start picking up bargains tomorrow, while the mess has still yet to be cleared. This group, not this group. But how about the aisles that are bustling? All right, what's there for you if you like me, you believe that inflation is running its course and the Fed knows what to do? Well, okay, so let me introduce you to these two terms. These are really what's driving a lot of stock market action right now. And a lot of people don't know them because they've gone out of style. I want to bring them back, all right? Right now, there are senior growth stocks and junior growth stocks. As much as I love the term FAANG, that is my acronym for Facebook, Amazon, Apple, Netflix, and Google, I think we need to broaden it out. Call them senior growth stocks because there are so many other senior growth stocks that are now being put in the cart. For example, we had a big move in Adobe ahead of its earnings on Thursday. That counts. This stock, which had lost its lift not that long ago, actually hit its all-time high today. It better be good when it reports. Microsoft works. NVIDIA, right? And after a long dormancy, Salesforce is starting to run too. When the banks plummet, the money flows into the financial technology plays, banking light, so to speak. So that means Square and PayPal see panic buying. Maybe Fintech should have its own aisle. Then there are the junior growth stocks, smaller and faster growing than their senior components. Now, there's, for instance, these stocks have been roaring. There's Twilio, the fantastic company that lets app developers push messages to the customers, among other things. There's Roku, which is the cord-cutting kingpin. CrowdStrike, we just had them on, right? They stopped crypto kleptos. Etsy, the online marketplace for all sorts of handcrafted goodness based in Brooklyn. And DocuSign, which has become the de facto way to close deals over the internet even after the pandemic. Junior growth stocks are beloved by Kathy Wood of ARK Invest, who had an incredible year in 2020, but was struggling in 2021 until recently. Often she seems to keep these stocks all by herself. Now, I am not against FANG and friends. I've been a huge supporter of the senior growth stocks, especially Amazon. But I'm beginning to believe that it's time to examine the stocks in the godforsaken aisle where people keep slipping on copper and lumber and iron ore, because now those stocks are going down. If you think, as I do, that the Fed will keep the fires going, you want to own a steel stock or a heavy machinery player or a chemical company. Cleveland Cliffs, it was down $2 today. Could go down under 20. You got to probably buy it then. If Caterpillar comes to 200, I mean, come on, let's buy that one. Dow Chemical, good yield. I even sanctioned some energy stocks because many of these companies have changed their suboptimal ways. Chevron, Pioneer, even Exxon. These are the kinds of companies that thrive when economies around the world are growing. And that's exactly what I expect.
Don't miss a second.
Jim Cramer.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Clean up in aisle 7. When you hear that in the supermarket, it can mean one of two things. Either you have to brace yourself for the mess because you need something from aisle 7, or it means nothing because you're not in that aisle and you have no reason to go there. That's this stock market in a nutshell. On a day when the Dow lost 86 points, S&P advanced 0.18%, the Nasdaq actually rallied 0.74%, with the S&P and Nasdaq setting new record high closes. We've got a series of aisles, some of which badly need cleanup, namely the industrials and the financials. But other aisles still have high demand, and it's tough to keep the merchandise on the shelves. Here's the problem. Most people insist on seeing the stock market as a totality rather than a market of thousands of different stocks. It's like the supermarket. See, there's the freezer aisle. It's not the same as the fresh produce aisle, right? They're different. But you often hear people treating them like an undifferentiated mass. When really rich money managers come on our air, their funds are so big that sometimes they can only be meaningfully trading the entire market, the S&P. They'd overwhelm most individual stocks if they tried to take a sizable position. So it's easier for them to flip in and out of the S&P 500 futures, which contain every aisle. You don't have to do that though, right? You can just avoid the messes and head straight for the clean aisles that are staying strong. If you get a cleanup on aisle 7 situation that takes down the entire market, think of it as a buying opportunity for the other better aisles, or entirely, if you really want to own one of those messed up stocks, maybe they're too low and you can do it. So what's the difference between a good aisle and a bad aisle? You get a crowd stuffing their carts with anything that moves in the senior and junior growth stocks right now. That suggests the economy could be cooling down, or the Federal Reserve might be about to slam on the brakes to tamp down on inflation. Too many rice cakes for the show. Once the Fed starts a tightening cycle, money managers start to swap out the cyclical boom and bust stocks, and they swap into the secular growth stocks. That playbook was a huge driver of today's action, as swift traders are trying to get ahead of that call. So what they're doing, they're selling these now because they think others are going to sell them later. Then there are the aisles where the jars are smashed and there's liquid all over the floor. And boy, that was the industrials today, where the glassware is flying all over the place. And there aren't enough mops to clean up everything. Oh boy, that was the bank aisle, where people were slipping and falling after JP Morgan Jamie Dimon talked about a 38% decline in trading revenue. Ouch! That's
30 minutes.
Of course,
41
once one jar
minutes.
gets knocked over, it tends to take down everything else in the aisle, which is why both Goldman Sachs and Bank of America got hammered too, even as the latter told a very positive story this morning on Squawk Box. I don't know if you caught it. It's really good. That ugly trading number from JP Morgan is a serious mess. It's a real problem. So you have to expect some analysts are going to cut numbers and maybe even downgrade the bank stocks tomorrow. That's why you can't get ahead of these things too quickly. But how about the other aisles? See, for the most part, nothing really newsworthy happened. That's what makes some of these moves so disconcerting to people. For example, no one said boo about Caterpillar, yet its stock fell for the 4th straight day. Now, some might say that's because Biden's infrastructure bill is stalled. Cat's now down nearly 30 points from its highs. But I think that misses the real driver. To me, Cat's falling because there's a perception that the Federal Reserve will have to change its posture at Wednesday's meeting. Now, I think that's wrong. But a lot of people are assuming Chair Powell will have no choice but to tighten after last week's red-hot consumer price index number. That's why the Dow Industrials really got hit today, but not the NASDAQ. The Dow is full of stocks that would be crushed if Powell gives the inflationistas what they want. That's this group, okay? This group actually does well on that, but I'm really focused from these. So these people need to listen to what Powell actually says, rather than presuming he'll stick to the Fed's old playbook. See, I really got to make this point. See, Powell's different. He's thrown that playbook out the window. I think Powell's very committed to an easy course, even if you believe inflation's out of control. He wants to keep rates low so that the unemployed and the disenfranchised get decent jobs. If the cost of a stronger labor market is above average inflation, so be it. Whether you agree with Powell or not, he's been very upfront that this is the plan. So I'm willing to wade into the beaten down industrial aisle and start picking up bargains tomorrow, while the mess has still yet to be cleared. This group, not this group. But how about the aisles that are bustling? All right, what's there for you if you like me, you believe that inflation is running its course and the Fed knows what to do? Well, okay, so let me introduce you to these two terms. These are really what's driving a lot of stock market action right now. And a lot of people don't know them because they've gone out of style. I want to bring them back, all right? Right now, there are senior growth stocks and junior growth stocks. As much as I love the term FAANG, that is my acronym for Facebook, Amazon, Apple, Netflix, and Google, I think we need to broaden it out. Call them senior growth stocks because there are so many other senior growth stocks that are now being put in the
Institute. So, Doctor, curious to know, how alarming is it that some of these recovered patients are experiencing these new medical problems?
All right, guys. So, let me quickly answer some of you guys' questions. So I have a question from. So I have a question. Have they announced it? Not yet. Not yet. Jamel, they are going to announce it in the next 35 minutes. If is the Fed decision, then in the next 1 hour is the I believe Jeremy is going to be speaking around as of 8:30 p.m. German time. So we still have about maximum 35 minutes till we are going to get the decision, and then in the next 1 hour we are going to see some more speech about it. So now price target if bad news $7.05. So there is a question from Lopez. If there is a bad news, what is going to happen with Bionano Genomics? I don't expect big things to happen. Okay, I mean, this is my support line right here. In worst case, I think we are going to come down to this level, just like maybe we are going to close like we opened today. Okay. I mean, today we opened around this $7.85 and we went as high as $7.70 because of the breaking news of the new analyst coverage of Bionano Genomics. So if there is a bad news, I think we are just going to see the price. I mean, hopefully we are going to see the price just come down on top of this support line. And if we see it break that line, hopefully we are going to, rise back up to on top of that line. So that's what I'm expecting, guys. I mean, you guys can easily see this right here. The stock is flagging, okay? BNGO is flagging. This is what is happening, guys. You guys can easily see. So I think in the next 30, 35 minutes, 40 minutes, we are going to, get a decision. And this right here is a bullish flag, okay? This is not a bearish flag. So hopefully we are going to break to the upside and we can go back to this $9 level. So we just have to, wait and see what's going to happen. And talking about what else can I talk about here? So if your question is if there is a bad news, $7.05 is somewhere around here. Let me put since you are the only person asking the question, let me put the horizontal line right here. So this $7.05, guys, I mean, if there is a bad news, just like you are saying, I think we can easily come down to this level and then bounce. This is the level that I was watching yesterday, $7.16. This is where I was watching yesterday. But unfortunately, or should I say fortunately, we didn't get there to that level. So if we come down to this level, I'm going to add to my position in Bionano Genomics. So yeah, this is a bullish flag. This right here is a bullish flag. Okay, you can easily see the flag. So I mean, normally it should break to the upside, and if we break to the upside, you guys should be expecting a rally like this, because this kind of decision, this is even pointing to $11. This kind of decision is, it comes once in a while. It's not something that comes every day or every month. So yeah, that is it about Bionano Genomics. Let me see if there is another question. I'm having a blast today with BSSPOTC. Congratulations, Zach. Congratulations, bro. Yeah, Jim Cramer is a boring guy. Super boring guy. Don't you think BNGO will close the gap? Yeah, there is a chance, because yesterday we were supposed to close that gap yesterday, okay? So if we get any news, I think $7.17, just like I already showed you, this is the 1 hour candlestick. So if we get any bad news, I expect BNGO to close this gap and then continue upward. I don't see any reason why Bionano Genomics should go lower, guys. I mean, fundamentally, everything is strong, solid for the company right now. So if there is a bad news, from the Fed, then we should come to this side, and you guys just have to be prepared for anything. I mean, this Fed decision is some kind of crazy thing, and that's why I am live since almost three hours now. I've been on this. I'm live trying to share this with you guys. So we just have to be patient. We have about 30 minutes left to this, and that's why I'm trying to entertain you guys with some some Yahoo Finance news, as much as possible. So let me see if there is another question. There is no question. I think that's all questions since. Let me see if there's another question from you guys. So no question, no more question. So that's all, guys. So let's get back to Yahoo Finance, and I'll be, I'm scouting to see if I can find some breaking news. But so far, I think I have shared every news today with you guys. So I'm watching oil on this side. I'm watching Tesla on this side. I don't expect Tesla. I don't know why Tesla went below $600, guys. I don't expect Tesla to also go below $600. So if there is a good news, Tesla should go back above $660 at least. If there is a good news, $660 around this level. So that's why I'm watching. I'm super pumped. And oil, there's no business, there's no reason for oil to be at this level, guys. No absolutely reason why oil should be at this level. So guys, this is something you might want to be watching, because oil is one thing that I was trading like heck. Okay, I mean, I used to be an oil trader every day. If some of you guys are from eToro, perhaps some of you guys know me. I used to trade oil all the way from here down to this level, and I was buying like crazy. I sold all my oil position around this level, I believe, around $50 level. There is no reason for oil to be around this $70 level, guys. So if I'm day trading this right now. This was the breakout, and then we saw another breakout in oil. That's why I am day trading this right now. I initiated my position in oil again, short position, of course. So if oil goes up, I'm expecting it in worst case to go to $75. Then I'm going to open another short position. Then if it goes to $80, I will open another short position. I expect oil to go down, like serious down in the coming months, years, maybe next year. Because whenever the price of oil is high, all these refineries, Saudi Arabia, they are going to open their tap because they can make a lot of money at this price. When oil is at $70, they are going to open their tap and start to pump it out as much as possible. And whenever they are pumping, it means supply is going to be higher than demand. That means the price should go down. So I am heavily trading oil right now, and hopefully it will keep going down so I can make a lot of money from oil. Okay, so let me switch it over to 1 hour so that you guys can see what I am doing with oil. So this is 1 hour chart of oil. And Nasdaq, this is the play of Nasdaq. I mean, you guys can see the resistance and the support right here. So day traders, today is the kind of day that day traders used to love, because whenever there is some crazy news from the Fed, volatility is always super strong. And that is why I believe I believe day traders are celebrating right now. And we long-term investors, of course, we also need to know what is going on. So should in case there is a kind of crazy news and Bionano Genomics goes down, I will just add to my position. Hopefully it's going to go below $7 so that I can add to my position. Right now I am heavily in BNGO as well, over $13,000 and if it goes down, I will add to my position. That's simply what I'll be doing. So there is no breaking news so far. We are still waiting. Guys. Putting how we will respond to a specific type of Russian act. There is another news from US president right now. Biden and Putin. There is some kind of talk going on, but I don't want to distract you guys with that's crazy news. So we just have to focus on the FOMC and the Fed rate decision. For those of you guys that are just joining me, this is what we are waiting for, guys. For those of you that are just joining this channel, this is what we are waiting for. So there's going to be a Fed decision around, you guys can see it right, FOMC economic projection. It's going to be in the next 27 minutes. In the next 27 minutes, this one right here, FOMC economic projections, and then there's going to be Fed's monetary policy statement as well. Then by 18:30, which of course is going to be like in the next 57 minutes, there is going to be FOMC press conference where Jeremy is expected to speak. And this is going to affect the market, as it is already affecting the market, maybe not massively so far, but that is what I am watching right now, guys. So you guys should stay tuned, okay? Please stay tuned.
Of big tech, as the chair It's a sign that the agency is likely to crack down even further on the industry's tech giants. Joining us now to discuss this is Congresswoman Pramila Jayapal. Congresswoman, thanks so much for being with us. We appreciate your time. Let's start with that appointment of Khan, now in the driver's seat at the FTC. What do you think it means for change in the tech industry? How might her appointment reshape the industry?
It's a very exciting appointment. I worked with Chairwoman Khan for the last 16 months as we worked on this investigation into antitrust. She has a very strong competence around this topic. She understands why we have to be aggressive in taking on monopolies and protecting competition with small businesses and choice for consumers. And the fact that she got an overwhelmingly bipartisan confirmation from the Senate was very good news. I think this is one of the areas where Republicans and Democrats agree that we have to do important work. And I think she's going to be aggressive in making sure that the FTC is both enforcing existing antitrust laws, but also, taking on whatever big challenges they can. And she obviously is very supportive of the recommendations that came out of the 16-month investigation of the Judiciary Committee last year.
Now, Congresswoman, another bipartisan initiative has been some of the big tech legislation, antitrust legislation, that you yourself are a supporter of as well. Curious to know, because the FTC previously had been a fairly toothless agency and going up against some of these big tech companies. You yourself said that some of them, frankly, were too big to care. We had seen some record-breaking sums, at least when it came in terms of fines, but they were really drops in the bucket for some of these companies. Going forward, how much do you think having Khan in the driver's seat as a chairwoman at the FTC, but also coupled with some of these new bills, that we'll actually see some measure of regulation and punishment that almost hurts some of these companies?
Well, we have to, because ultimately we are about ensuring competition thrives, innovation thrives, small businesses thrive, and that consumers have choices. And I think the combination of Chairwoman Khan, her understanding, her aggressiveness on this subject, but then these 5 bills that we just introduced on Friday, bipartisan bills to really take on the monopoly power of these dominant tech platforms, is going to provide additional tools to the FTC and the DOJ to do what they need to do to rein in this anti-competitive behavior and ultimately to have really meaningful fines levied and to structurally separate lines of business. And that's the bill that I have, the Ending Platform Monopolies Act, which says that you cannot have, and it will be unlawful with this bill, to have a dominant platform actually own and operate multiple lines of business that produce conflicts of interest. Because when you have Amazon selling and allowing others to sell on their platform, so they get all the data, they set all the terms, and they basically have a dominant advantage to be able to
of the United States.
It drives businesses out of business. When you have Google buying and selling ad revenue on the same platform, it hurts independent publishers. When you have Apple controlling the app marketplace so that people can't even get off the ground without access, it hurts consumers and those small businesses. And the same thing, obviously, with Facebook. So I think that this is a really important set of bills. They are all bipartisan, and they will provide new tools to the FTC and to the Department of Justice to ensure that we preserve competition and that we protect consumers.
Well, certainly, Congresswoman, response from the tech company was pretty swift here. They're saying that these proposed regulations would, in essence, kneecap, that's their word, American companies, undermine innovation, especially at a time when we are trying to become more globally competitive, especially as it relates to China. How do you continue to foster innovation while mandating these regulations and these parameters in which the companies would have to exist?
Well, what's really interesting is that these bills are the result of a 16-month investigation with hundreds of small businesses testifying, many, many hearings, and tens of thousands of documents that we got from the tech platforms to really examine exactly what was happening. And then, of course, culminated with having the CEOs of those 4 companies come and testify. And I think part of the reason you have this bipartisan agreement is because it is very clear that while the tech platforms say that they are actually fostering an innovation and competition, they're doing exactly the opposite. We heard from hundreds of small businesses who have either been put out of business or, had their business greatly diminished, or feel like they have absolutely no choice to get off of that platform. And so that is why I think we have seen in the history of antitrust, whether it was the railways or the baby bells, or whether it was Microsoft, which had to go through something similar with an antitrust lawsuit that was filed and the settlement that was made, that it was those settlements, those breakups, all of those things that actually helped ensure that there were other businesses that came up and were able to innovate, that these dominant platforms didn't have so much power that they could stop that from happening. And I think that's why there's overwhelming support across the country, across partisan lines, to make sure that we do rein in these big companies, these big tech platforms, and provide more tools to ensure that they do not become so dominant that they are too big to care, as I asked Mark Zuckerberg during the questioning.
Yeah, interestingly enough, some actually antitrust legislation aimed at Microsoft in the 90s gave rise to some of the companies that you guys are going after right now. Everyone says that increased competition is essentially going to be good for consumers, but some of the criticism and the response that some of these companies have had is that actually these bills in the long run are actually going to harm the consumer. What is your response to that? And are you saying that there is absolutely no risk at all that going after a company, for example, like Amazon, isn't going to result perhaps in higher prices for consumers down the road?
Yeah, it's so good that you mentioned that about Microsoft, because we actually had Brad Smith in to testify in some conversations. I've been in deep conversation with him. Obviously, he also is from our region, from my district. And I think that's exactly right. And it shows why ultimately you help consumers when you undertake strong antitrust regulation. The reality is that we believe in innovation and competition as being the best opportunity for consumers to get the best prices and the most choices. When you have dominance of the level that you have with the 4 tech platforms, the reality is that that is not what we see in the marketplace. These small businesses have literally no opportunity to thrive. They are forced into agreements that they have to abide by while the dominant platform does not. They are forced to either sell or be acquired or be killed. They are forced to agree to all kinds of products in order to get the preferential placement on these platforms. And so in every way possible, I think what we will see is the market will restructure, and ultimately it benefits those small businesses and the consumers. And the high prices, let's just be clear, when you kick everybody out of business, you may have some low prices for a very short period of time, but the minute there is dominance in that market, you will again see those prices increase. That's the whole point of antitrust, is to prevent that dominance from happening, because while you might undercut initially, ultimately the consumer's paying a higher price.
All right, we're going to leave it there. Congresswoman Pramila Jayapal, thanks so much for your time today. Good to see you. All right, coming up, General Motors plans to boost spending on its electric vehicles. We've got the details coming up.
So, guys, it's more or less like, this is being priced in. It's like the market already knows what's gonna happen. As you guys can see, it seems like investors are jumping on board again, and they are pumping stocks already. You guys can see, apart from Nasdaq is more or less not doing anything. Nasdaq is, more or less still trading at all-time high. If we zoom it a little bit, let me put it to the dailies. You guys can see that Nasdaq is more or less trading at all-time high. If you switch over to the dailies, you can see it's more or less like, I think there will be a lot of short sellers around this level, thinking they have caught triple top. This looks like triple top. some short sellers, some day traders would be opening short position in Nasdaq right now, hoping to cash it, from the top and then ride it back to the bottom. So you guys can see it looks like Nasdaq looks like it is overbought, okay? But apart from Nasdaq, if you take a look at Tesla seems to be recovering, okay? Tesla started today around this level, so more or less Tesla is green right now. Let me see how much. I want to see how many percent Tesla is up already today. So Tesla right now is up about 1% right now, about 1%. BNGO is up about 1.76% right now. So you guys can see it's like investors already, insiders already have some kind of information about what we are expecting, and it looks like it's more or less a good news from what is happening so far. I mean, you would expect the market to be selling off, but that is not what is happening. And of course, you can see oil keeps going down. I think oil should just, I'm expecting oil to go down, like seriously down, maybe to 70, maybe even to $70 US. It may not be today, maybe tomorrow. That's what I'm expecting from oil. So it's good so far. This is good. This is wonderful news. This is the kind of things we want to see, okay? I mean, we don't want to see the stock market crashing. We want to see the price at least going up. But, I'm going to wait till the Fed interest rate decision before I would make some kind of attempt, to open a position or whatever. So this more or less like buy the rumor and sell the news kind of thing going on. So we just have to wait and see what is going on, okay?
By 30%. We have Yahoo Finance's Emily. Hi, Kristen. And as you mentioned, we are hearing General Motors increasing its planned investments into electric vehicles and autonomous vehicles for the second time in under a year. And we should note that the stock is moving higher by more than 1% following the news this morning. Now, specifically, General Motors said that it plans to spend at least $35 billion on launching about 30 electric vehicles by 2025 and opening 4 battery electric facilities, including the 2 it has already announced in Tennessee and Ohio. Now, General Motors CEO Mary Barra saying in a statement this morning, quote, GM is targeting annual global EV sales of more than 1 million by 2025. And we are increasing our investment to scale faster because we see momentum building in the United States for electrification, along with customer demand for our product portfolio, end quote. Now, GM has been steadily increasing its plans for building out its EV fleet over the past year, as I mentioned earlier. Originally, it said in March 2020 that it would spend $20 billion on electric and autonomous vehicles over the next 5 years or so. Then in November, it raised that sum to $27 billion, and now here we are at $35 billion. Now, GM already has a number of new models that are going to be in production this year. That includes an EV Hummer, Cadillac Lyriq SUV, and electric Chevy Silverado pickup truck. So already seeing a number of these in the pipeline here for consumers. Now, in terms of why now for this announcement, do you want to dive into that a little bit? But GM did say that this is mostly because of its better than expected financial results for the first half of 2021, which is allowing it to make this additional investment. GM also raised its guidance for the full year, or for the first half, I should say, and it now expects that first half adjusted EBIT will come in between $8.5 billion and $9.5 billion. And that is a pretty significant step up from the about $5.5 billion on that measure that the company saw previously. So again, Kristen, Alexis, really seeing a major step forward here when it comes to this planned investment by General Motors. And we'll see how this actually plays out for the company as it tries to compete with the likes of Tesla, Volkswagen, and Ford, which we should mention also recently made an increase to those EV investment decisions. All right, thanks so much, Emily, for breaking all of that down and giving us all of the details. And coming up next after the break, we are moments away from guidance from the Federal Reserve. Right now, all 3 major indices are in the red, but trading fairly flat as they hope to get some guidance. We've got a preview of what to expect right after this.
So let me quickly take a look at FOMC while Yahoo Finance is on pause, on a break. So CLOV, you want me to check out CLOV? CLOV is selling off. It's selling off right now, guys. Let me take a look at it. CLOV. So I'm going to put this right here and CLOV. Global Health Investment Corporation. So CLOV is down minus 7.66% right now. I mean, why would it be going down? Possibly because of the FDA shifting. I want to see if there's some kind of breaking news, pertaining to CLO. There's no breaking news, I think it's more or less going down because of all this interest rate decision. In my opinion, I mean, that's what I can find so far. There is no reason why this stock should be going down heavily right now. And if you take a look at let's quickly take a look at the 5 minutes. This is the 5 minute chart. Since the market opened, this stock has been selling off. CLOV, you guys can see it right here. It has been selling off. So if I would want to invest in it, where would I invest? Where would I buy? So there seems to be a gap. You can easily see there is a gap right here from CLOV. I'm going to put horizontal line at that gap. So there is a gap right here created on the 7th. On the 7th of this month, there was a gap, a massive, gap up. And then right now the stock is trying to, it's trying to close the gap at 11.90 something, like around $12 US, okay? Let's say $12 US, around $12 US. So we still have about 71 cents, down. I mean, on sell off before I believe this stock is going to find a support, and hopefully it's going to bounce. If you are invested in this stock right now, CLOV, I think CLOV is also one of those meme stocks out there, talking about GME, talking about AMC, Naked, and so on and so forth. So I hope this answers your question, okay? I mean, if you want to add to your position, you should be watching out for this $12 US level, okay? Now, let's quickly take a look at the stock. Since Yahoo Finance is still on a break, let's take a look at, I saw one stock that went up extremely up today, guys. I think it is RBLX. No, not RBLS. There was one stock I just showed that went up like 90%. Where is it? Yeah, this stock, OFAZIM. I mean,
we are about 10 minutes away from the Federal Reserve's decision on monetary policy. And while no moves are expected today, you can bet that investors will be listening for clues as to when the Fed's going to start to take its foot off the gas and say that it's going to start tapering its bond purchases and raising interest rates. Here with a preview now is Tony Rodriguez. He is head of fixed income strategy at Nuveen. So Tony, thanks for being with us. Do you expect the Fed to telegraph today that they have begun thinking about raising interest rates?
Well, good to be with you. Good afternoon. We don't expect to see anything in the statement indicating that, but we do believe that in the press conference he'll clearly be asked about it. And I think that we'll mention that there's discussions that have maybe begun around the taper. And in fact, if there isn't a discussion around the taper, then that's probably the only group in the country that isn't talking about the taper right now.
Do you think, Tony, that if we do get some guidance, some hints around that taper, that it could result in a taper tantrum? Or do you think that we perhaps already saw that taper tantrum before?
I think you're exactly right. We think we saw the taper, the tantrum, not the taper, but the tantrum in the first quarter. We moved from, 92 basis points on the 10-year to 1 3/4. Where we sit today, we think is pretty consistent with just a reopening of the economy, continued support by both fiscal and monetary authorities. And we think we'll continue to see upward pressure on rates as we move through the balance of the year. But we do think the Fed will be changing some of their forecasts for 21, given the better data that we've seen over the course of the first 6 months of the year. And they will continue to very strongly emphasize that they believe inflation pressures right now are transitory, and therefore they won't have to respond to these elevated numbers that we're seeing in the last 2 months and we expect to see over the next couple of months.
I want to talk about what you're seeing bond investors telling us about inflation. It looks like bond yields peaked about 2 months ago, and since then we got two very hot reports on inflation. So what do bond investors know here that we don't? What are your expectations for bond yields over the summer?
Sure. And I think that the bond market is telling you that they're buying into the transitory description for the inflation pressures that we're seeing right now. So if you look at, for example, the cost of a cap on inflation at 2.5%, that cost has begun to decline. I think some of the key drivers have been that you saw the employment numbers decline from that million per month pace to more of a 500,000 or 600,000 pace, so that the pressure in the employment market won't be quite as acute. And when you look at the inflation data, as much as half of the increase is from used car prices, for example, airfares, parts of the reopening of the economy. And we certainly don't think used cars are going to get more expensive than new cars. So we think the pace of increase there will decline as we move through the summer months, when supply can come back online and some of the incentives around not coming back into the labor market, whether it's supplemental employment insurance, schools that aren't open, a lot of that obviously goes away by late August, early September. So the bond market, I think, is telling you that they're buying into that transitory nature. And so therefore, we think the upward pressure on rates will come from just the continued recovery and reopening of the economy. And we think that pressures, for example, the 10-year up to close to 2% by the end of the year. But we're not expecting it to be a very volatile move or substantially higher than that 2%. And we think that'll be consistent with supporting kind of the broader financial markets, meaning equity markets, risk assets, and fixed income. We believe that they'll be able to handle that type of increase in treasury rates.
All right, Tony Rodriguez, head of fixed income strategy at Nuveen. Thanks so much. We appreciate your time today. And we are moving closer, folks, to that decision from the Federal Reserve. Again, we're going to be looking at their statement very closely, but I think the real action is going to come when Fed Chair Powell takes over with his press conference at 2:30 Eastern time. We're going to be carrying that for you live right here. And in just a minutes, we're going to kick off our Federal Reserve special with a panel of experts. So don't go anywhere. Kristen and I will be right back.
So Yahoo Finance, Bionano Genomics keeps going higher, oil going lower, and Nasdaq is more or less waiting for a decision from the Fed before it makes up its mind. So this is the situation of the markets right now, guys. I mean, we have 4 minutes left before there is going to be this announcement. 4 minutes. 4 minutes. Four minutes, guys. We have 4 minutes left. What's up, Brian? What's going on? Today's FOMC, interest rate decision. That is what the Fed is trying to do. They have to tell us if they are going to increase the interest rate or leave it like it is. And that is going to affect your investment. If you are day trading also, it's going to affect the market. As you guys can already see from oil, going down. This is, look at that, oil in 2 hours. In 3 hours, oil has gone from, around 71.70 US dollars to 72 almost 70 US dollars within 1 hour, up and down. So that is what is happening. And you can see Nasdaq right here, selling off as well. And of course, Bionano Genomics also sold off a little bit. And Tesla is more or less, staying positive so far. So in the next 3 minutes, we are going to know the decision. Then in the next 33 minutes or so, there's going to be a Fed meeting, and Jeremy is going to be speaking to let us know what they are going to do and so on and so forth. So we just have to wait and see. Okay. It's super hot in Germany today, guys. I mean, it's 30-something degrees. $27°C. 27 degrees in Germany today, guys.
Welcome into the 2 p.m. hour here on Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous, and we're also joined now by Yahoo Finance's Adam Shapiro, as the three of us are waiting some guidance and a decision from the Federal Reserve. Taking a quick look at the markets right now, all three major indices are in the red. However, trading fairly flat. However, the Dow is down about 150 points right now as equities are awaiting some kind of guidance and direction from the Federal Reserve. First, however, I want to go to Adam, just for some of your thoughts, what you are expecting in just a few minutes to come from the Federal Reserve and from Fed.
Was the interview that Brian Chung did back on June 3rd with John Williams from the New York Bank. He's the president of the Federal Reserve Bank of New York. And the quote that's really crucial here is that Williams said, "We are all still quite a ways off from maintaining the substantial further progress that we're really looking for in terms of adjustments to our asset purchases. We're not near the substantial further progress marker." So in this talking about when they would do a taper and possibly pull back, you got to listen to someone like Williams because, one, he's a permanent member of the FOMC. But the other voting members today who are on the FOMC, they're not the loudest chorus of it's time to start talking about talking. So it looks like we'll get a statement that is pretty much status quo.
Whoa, did you guys see that? Look at NASDAQ.
I mean, I think when we're talking about tapering just really indicates just how nuanced some of these things are right now. I want to go over to Yahoo Finance's Brian Chung right now, who can break down the latest decision from the Federal Reserve.
Look at NASDAQ.
So much, Kristen. Well, we are still awaiting the Federal Reserve announcement, and it looks like it just came out. So the Federal Reserve projecting, actually, interestingly, 2 interest rate hikes by the end of 2023. This is a noticeable upward revisions from where we had seen the Federal Reserve put its projections in March of 2021. At that time, you'll recall that the median member of the FOMC projected no rate hikes through the end of that time horizon. This coming in the summary of economic projections. The Fed releases these every quarter. Now, the Federal Reserve in its policy announcement not making any changes to the actual policy rate as of right now. So the Federal Reserve keeping interest rates at near zero, and no announcement necessarily on the Fed balance sheet. They're continuing to commit to at least $120 billion in asset purchases per month. That would include U.S. Treasuries and also agency mortgage-backed securities. But these projections are really going to be in attention. It'd be interesting to see what bond markets are doing, but I want to read you some of the upward revisions, and it seems to make sense. Some Federal Reserve officials seeing the case for maybe higher interest rates a little bit sooner because of more optimism over the economic recovery. So when you look at GDP projections, for example, the FOMC now, the median member of the FOMC now seeing the case for 7% GDP growth in the year 2021. That's a noticeable uptick from the March projection of 6.5%. And then inflation, they now expect core PCE, which is the Fed's preferred measure of inflation, to clock in at 3% for the year 2021. That's a noticeable uptick from the 2.2% that they had projected back in March. Now, all of that is coming while the Federal Reserve still sees a lot of legwork to go in the labor market, because interestingly, the Federal Reserve not seeing any sort of change in the unemployment rate projection. They kept that the same compared to their last round of forecasts in March at 4.5% on the headline number. Now, in the statement itself, I want to point out just some changes in the language that the Federal Reserve used. Not much changed, again, because the Federal Reserve keeping interest rates steady, but they noted that progress on vaccinations has reduced the spread of COVID-19 in the United States. Not necessarily anything new on that front, but interesting to see how they changed the language in the middle of their statement to say, well, progress on vaccinations will likely continue to reduce the effects of the public health crisis on the economy, but risks to the economic outlook remain. Now, the risks to the economic outlook remain is language that they had repeated from the April statement the last time we had a meeting from the Federal Reserve, but that bit about the vaccination and kind of attaching that to the caveat for how the economy is going to progress over the next few months was new in this particular June statement. Now, this was a unanimous decision. There were no dissents among the voting members of the FOMC. And before I finish up my rant here,
look at gold, guys.
The Federal Reserve did extend its U.S. dollar liquidity swap lines with 9 major central banks around the world that was set to expire in September. This is just to make sure that there's still a continuing flow of U.S. dollars as the world continues to struggle with COVID. And then the last bit is a very technical change with regards to the interest that the Fed pays on reserves and excess reserves. That was increased from 10 basis points, as we've seen over the last few months, to now 15 basis points. And without getting too into the nitty gritty, this is not at all raising interest rates. What this is doing is trying to guide the effective overnight borrowing rate something closer to the central of the Fed's range. We know that the Fed is targeting between 0 and 25 basis points on short-term interest rates. That's been drifting towards the bottom end of that range, closer to 0, because of just the amount of swelling on bank balance sheets with the amount of reserves that are out there. But overall, to encapsulate what the announcement was today, interesting to see the Fed now projecting more rate hikes than we had seen in March, again, 2 by the end of 2023. But at least for right now, no changes to interest rates, no changes to quantitative easing, and of course, we'll be awaiting that press conference in about 25 minutes or so.
Oh, definitely not a snoozer and a bit of a surprise, as you say, now forecasting 2 rate hikes in 2023. And we saw a pretty aggressive move to the downside in equities once that announcement was made. Brian, the Dow was off more than 300 and the NASDAQ was off more than 100, although they're coming off those lows right now. What do you think those 2 rate hikes, those projected 2 rate hikes in 23, mean about the way the Fed is thinking about inflation? There's no word, of course, there and as to whether or not they think it's going to be transient, which has been Fed Chair Powell's big word, right? Will inflation be temporary? Does being more aggressive on the rate front mean that perhaps the Fed is thinking differently about inflation going forward?
Not necessarily, and that's an important point that you make, which is whether or not they're mutually exclusive for Fed officials to, on one hand, think that inflation is transitory, but then on the other hand, want to have a quicker reaction to raising interest rates. And the reason for why that is because when it comes to transitory nature, right, that could expire at any point in time. The question is, if you have 2 people in one room that say, well, I think that's going to be temporary, I think that's going to be temporary, they can both still have different timelines for when whatever temporary effect is being assessed will expire. So I think the idea here is that while some of these Fed officials do think that price pressures will be transitory, whether or not that's coming from the base effects of trying to compare current months to year-ago months that really represented the depths of the pandemic, or because of supply chain disruptions that have made it more difficult for producers to find things, which is the reason why they're raising prices. Well, yes, you can have 2 Fed officials that feel they are both in effect, but you can have one that says, well, I think those will fade and that ultimately that won't be an issue in 6 months, versus the other Fed official saying, yeah, well, I think this is going to be an issue for another 1 year, but then it'll still also fade away. So I think what's very interesting as we head out of this meeting, again, we want to clear the press conference this week to see how Chairman Powell tries to maybe put a dovish spin on these dot plots, but we will want to see in the future how Fed officials in the press or in public responses or public speeches try to explain and square those 2 things. Now, of course, Fed Chairman Powell, for his part, probably would prefer to downplay this and say, look, at the end of the day, these dot plots are just projections. All of this could change depending on how data come in over the next few months or even years. And we've already heard the Fed chairman say in previous speeches that the dot plots are not necessarily the best way to read Fed policy, and that you ultimately want to make sure you remember that the Fed is outcome-based, not outlook-based. And these dot plots are very much outlooks. So I think that's what we should expect to hear the Fed chairman say in about 24 minutes or so.
All right, Brian, thanks so much for breaking all of that down for us. I want to bring in Andrew Levin now. He's a former Federal Reserve Board special advisor and an economics professor at Dartmouth College. So, Professor, of course, there's no mention of the tapering on some of those asset purchases. They've left rates unchanged. However, some interesting surprises here, an uptick in some of those interest rate hikes. We now have 2 by the end of 2023, an uptick in the projections, at least when it comes to inflation. So I want to ask just what your reactions are to the guidance that we're getting, the decision that we got from the Federal Reserve just a couple of moments ago, considering some of those surprises.
Oh, well, it's great to be with you. The first thing to point out is that the statement they issued a few minutes ago says almost nothing about the incoming information. There's one change in tense of a verb, and that's about it, other than referring to vaccinations, of course, which we're all really pleased to see that a lot more of the public is now protected against COVID. The real news that's been coming in is that inflation's really picking up. And just to be concrete about this, it looks like over the first half of this year, the core PCE inflation, which is the one that Fed typically relies on the most, is going to come in at 4.5%. for the first 6 months of this year. So now you look at their projection of 3% for the year as a whole. What that would mean is that starting in July, core PC inflation would have to jump downward from 4.5 to something like 1%. I just don't see it. So probably what's going to happen is that in July, they'll knock up their projections for this year further. Maybe by July, early August, it'll be at 3.5 or 4%. The truth is we're probably heading for a year where core PC inflation could be around 5%. And then the question is, what happens in 2022? Does it abruptly drop right back down to their target of 2? I think there's good reason to think not. The consumers' inflation rates are picking up, commodity prices are picking up. A lot of producers are expecting that inflation is going to continue to be high. So the whole notion that this was just a persistent issue, a transitory issue, is really fading quickly. And the Fed needs to make sure that it's not behind the curve. If they wait another few months to start talking about tapering, and they wait until 2023, maybe the second half of 2023, to start raising rates, could be too late to make sure that inflation stays under good control.
So, Andrew, you just brought up the issue of controlling inflation. We know they can very quickly at a meeting move interest rates, but it's the taper issue, the $120 billion, which there's no change in that policy. How quickly would a change in beginning the taper have an impact on controlling inflation?
Well, these things are all tied together. They have a very complex policy right now. But if you just look back at what happened the last time around, they started tapering in 2013, and it took almost a year and a half to finish the tapering. So what they've been assuming up until now was that they could start tapering in, say, early next year, finish tapering sometime in mid to late 2023, and start lifting off in 2024. This median outlook, let's say in the dot plot as of now, is starting to put a little pressure, okay, that maybe they're going to have to taper faster and finish the taper next year. But still would be okay that they lift off sometime in spring or summer of 2023. The problem is that if inflation's picking up to 4 or 5%, and it's going to be persistent over the next couple of years, they probably can't wait that long. Now, I just want to emphasize here a couple things about the dot plot. There's a lot of emphasis on the median. I would say that's probably overemphasized. I think that really the thing to look at is what's changing in the dots. And what's noticeable to me is that you now have 7 out of 18 participants who think that they should lift off next year. And of the projections for 2023, you have 8 people who think that by 2023, the federal funds rate target should be up around 1% or even higher. So the point is here that, as someone said, I guess it was Adam, they're outcome based, but the outcomes here are clearly pointing towards significantly higher accelerating inflation and expectations moving upward, that they will probably need to start tightening next year. Then the question is, how do they do a taper? Could they start the taper this September and finish the taper next June and still give them time to lift off next fall? That's starting to get very compressed. That could create strains in some financial markets. So these are really challenges. And the longer the Federal Reserve waits to unveil what they're planning to do, the harder it's going to be.
Certainly time is of the essence. Andrew Levin, professor at Dartmouth, thanks so much for being with us. I want to turn things over now to Lindsay Piegza. She is chief economist at Stifel. So Lindsay, good to see you. I want to bounce off of what Professor Levin was just saying. You know, some market strategists say this economic crisis is over. You've got the economy soaring, wages are moving higher, inflation is hot right now. The economy doesn't need $120 billion of newly printed money every month. Is not tapering, starting to taper now, overkill from the Federal Reserve, and could it actually be dangerous down the road?
Well, I think it's interesting when we look at the upgrades that we see in this most recent set. The Fed did increase their expectations for inflation as well as growth and rates, but the labor market metrics were very much unchanged. So I would expect the chairman to really emphasize some of the uneven nature of the recovery during the upcoming press conference and really highlight the fact that, yes, we have taken great strides in terms of getting Americans back to work, but we're still talking about millions that have yet to be replaced to a position of gainful employment. So I do think that the Fed's focus is predominantly on the labor market, and the still incomplete nature of the recovery in the labor market justifies the Fed's continued accommodative policy at this point, at least from their perspective.
Lindsay, when you talk about them justifying that policy, it was Lael Brainerd, the governor, who said it's also important to be attentive to the risks of pulling back too soon. We're seeing the markets react to this news about more of the members looking at interest rate increases sooner rather than later. But does this change those statements about we're worried about pulling back too soon?
No, I think that Fed officials are looking at both sides of the argument. On the one hand, they are aware that inflation is on the rise. Now, they're not necessarily overly concerned about inflation, as we heard the other guests mention. They've been very clear that they perceive inflation as a result of base effects or the economy recalibrating, both of which will begin to recede their pressure on prices as we head towards the end of the year. But on the other side of the equation, the Fed wants to be very careful to continue to nurture this recovery, because right now there still is a lot of artificial support, particularly from the federal government. And so the Fed doesn't want to be pulling the rug out from under this recovery. At the same time, a lot of these benefits, these emergency measures from those in Washington are set to expire in the coming weeks and months. So I do think that Fed officials are looking at both sides of the equation, and they're walking a very delicate line, trying to balance the risks of inflation and continue to support the recovery.
Lindsay, I'm really glad you made mention of some of those benefits, the Fed pointing to the labor market really as part of the reason they don't want to take that punch bowl away from the party just yet. We're in this really interesting environment right now where the labor market is tightening. We hear employers saying, listen, we have the jobs, we want to hire people, we're trying to offer more money. And frankly, right now, we just can't find the workers. We can't find the employees, even as we see millions of folks still out of work. So what is it going to take to get the labor market off of its knees and really back onto its feet? Is it part of those controversial policies of canceling some of those jobless benefits early? Are we going to see that happen when they expire? Or is there something else going on here, at least in terms of salaries and benefits that need to be contended with?
I think it's a number of factors. I think there's still a lingering impact from the virus, some people experiencing long-term effects. We also see daycare and schools as an issue as well. So once we start to move past summer, which a lot of summer activities were closed or at reduced capacity, and we get kids back in school full time, that's going to help working parents being able to move back into the labor market. But of course, we also have the policy issues. When you're offering someone X to not work or X minus 20% to work, most rational agents would choose that larger sum. So it's certainly not a political statement or a judgment by any means, but it's a recognition of the fact that we have rational players in the labor market. So as long as that opportunity is out there, many workers are going to take advantage of that program that the government is offering. Now, those benefits are set to expire in September. As we get, again, kids back to school, those programs expire and we continue to reopen the economy, I would expect the pool of available labor to grow markedly, really easing some of those pressures that businesses have been reporting in terms of not being able to fill the existing vacancies.
All right, Lindsay Piegza, Stifel's chief economist, thanks so much for joining us. I want to turn now to Yahoo Finance's Jared Blakely for a look at the market reaction and some of the biggest movers. And Jared, the Dow not liking some of the news. We had seen it extend some of its losses shortly after the Fed's decision.
That's right, really interesting market reaction. Some of the biggest market reaction that we've seen from the 2 p.m. report that in some time, actually, I can't remember the last time the market moved this much. So let's take a look at the Wi-Fi Interactive where we have the Dow, and you can see the sell-off after 2 p.m. here. Usually we see the fireworks when Jay Powell is speaking at the presser. You can see the market was clearly surprised by this. NASDAQ actually dropped the most here, and that's because of the heavy exposure to tech. S&P 500, similar story. Guess what though? Russell 2000, yeah, it's down a little bit as well, but not as much because those small cap stocks, actually, a lot of them tend to like that expanding yield curve. And that's exactly what we're seeing here. We see the 10-year T-note yield shooting up, and you can see on a 2-month basis gives you some more perspective here. We're still off of these lows, which are multi-month lows, but nevertheless climbing higher here. Here's the U.S. dollar. We saw the dollar strengthen on the move, And I'll get to the sector action in a second. I just want to show what's happening with gold futures. Gold futures got down on the announcement. That's a 2-month chart. Let's take a look at an intraday. There you go. Now, as we would expect from an expanding yield curve, we would think that financials are the biggest outperformers, and in fact they are. And the biggest underperformers are those big sectors with the mega cap. So tech, communication services, as you see there, staples. Nobody's buying staples.
Everything
in
is
an
down,
expanding
guys.
economy. That's a defensive play. So if we take a look at the banks, we see a lot of green. That's what we'd expect. Citigroup is the exception because they guided to lower trading revenue yesterday. But other than that, seeing a lot of green. Now, the flip side is, let's take a look at energy, for instance. This is one of those value and cyclical sectors that was underperforming today. You would think it might be, maybe get a little bit of a bid, but I tell you what, the sector action today, very interesting, and I can't wait for that presser because there's going to be a lot of questions around those rate hikes.
We can't wait either. It's about 11 minutes away. All right, thanks a lot, Jared. Let's bring in Zach Griffiths now. He is a macro strategist, senior macro strategist at Wells Fargo. So Zach, were you surprised that the Fed today was very transparent, forecasting 2 rate hikes sooner rather than later and more aggressively, 2 of them in 2023, but yet made no mention of starting to taper those bond purchases?
Thanks, Alexis. Yeah, it's certainly an interesting dynamic, and I think the move in the 2023 median dot was larger than most had anticipated, and you're seeing a big reaction in the front end and the belly of the curve. But yeah, as we expected, the forward guidance, at least in the policy statement around asset purchases, remained the same, and no changes there is consistent with our view that the Fed is going to wait until the December meeting of this year to announce the taper for it to actually commence in early 2022. So no taper yet, and that's been something that we've been focused on for a while.
Zach, if there's no taper yet, are we seeing an overreaction? And I know markets tend to overreact on Fed days, but is this an overreaction that we see on the selling in equities?
Well, it's certainly interesting. I think equities responding to the big increase in policy rate expectations, both in 2022 and in 2023, relative to what the market seemed to be expecting, is not overly surprising in the sense that it seems like the Fed is willing to tighten policy down the road more quickly than they had been previously. It's interesting when you look at the dots relative to the adjustments they made to their economic projections, huge increases in the GDP rate and PCE and core PCE in 2021, but out in 2022 and 2023, very small changes, if any. So you have the median dot moving higher, but they're really sticking to this transitory inflation story with the summary of economic projections.
Yeah, Zach, we were talking to Andrew Levin just a couple of moments ago, and he doesn't exactly see everything the way that the Fed does. But of course, the primary advice we always hear given to investors is do not fight the Fed. So how should they be approaching the markets, their portfolios, with an eye on not fighting the Fed, but also considering that so many folks out there do not necessarily think right now the Fed is getting it right?
Yeah, it's a difficult situation to balance, and we remain in the bond bear camp. So we think that investors should position for higher yields. It's been a tough camp to be in for the past couple of months as yields have come down. But we think the fundamental story is really still there, with very heavy treasury supply and a very broad economic reopening globally, unlike we've seen in recent history. And our colleagues in economics call for GDP growth to top 8% this year. So we think with rising inflation, heavy supply, and this economic recovery that's really global in scale is going to push yields higher for the remainder of the year.
Zach, back to the no taper announcement quite yet. We've got the housing market at all-time highs, feverish growth and speculation in that industry, yet we still see the Fed buying $40 billion of mortgage-backed securities each and every month. Do you think that that is smart given the backdrop right now?
That's a great question. And we think that when the Fed thinks about monetary policy, I don't think it's going to address MBS in the sense of tapering MBS before treasuries. But when it does decide to taper, we could see them tapering MBS at a slightly quicker rate than treasuries as a way to cool off the mortgage market, cool off the housing market a bit. As you've said, we have seen tremendous growth in housing and markets remain hot really across the nation. So that's something we could see them doing, but we don't think that they would address MBS without addressing treasuries from a taper perspective.
All right, Zach Griffiths, Wells Fargo Senior Macro Strategist, thanks so much for joining us. We are just a couple of minutes away, about 7 minutes away from hearing from Fed Chair Jay Powell. But before that press conference starts, let's bring in our final panel. We're joined now by Calvin Schnurr, Senior Economist at NAREIT and a former Fed economist. We also have Jeanette Garrity, Chief Economist at Robertson Stephens Wealth Management. So Calvin, I'm going to ask you this question, given your time at the Fed. Has the Fed created right now this monster of easy money, even in this announcement, not even talking about tapering? They're keeping interest rates where they are currently. And how difficult is it going to be to slay that monster of easy money, considering this environment that we have been in for so long?
Well, there's a different way of looking at their asset purchases, and you've got to think the Fed's got 3 policy objectives, and people normally talk about the first 2, full employment and price stability, but they're also interested in financial stability. And what they're doing with these asset purchases is making sure that there's plenty of liquidity for the banks, for the financial system, so we don't have something that happened last March, so that we don't have some of the dislocations we had in 2008, 2009. So what they're really doing is helping secure that the financial system can keep the economy on a steady track. And that's really important. You can't achieve either of the other objectives without that goal.
Jeanette, these inflation projections that we're getting from the Summary of Economic Projections, I mean, some people may not be old enough to remember 3% core PCE from 1990. I think that was the last time it grew that fast. But from an investor standpoint, on one hand, we're seeing this in the dot plot and the SEP, but on the other hand, the statement is saying, pay no attention to that man behind the screen. What are we missing?
Actually, if you look at the,
I'm just glad you didn't bring up 1979. So, we don't want to go over that far back. I think what they're saying is, and I think you want to look at the language in the press release. I don't know what's going on over in the press conference, but in press release, there is a little bit more emphasis in the press release to the fact that what they're looking at in inflation. I think you have to compare press releases and see that change happening. So they are paying attention, but I think the way they view it is that there is not conclusive evidence as yet that we've got a firmly established higher inflation track. So there's not the evidence as yet to counter their view that a lot of what is going on is in fact temporary.
Calvin, we keep hearing the Feds talking about wanting to reach full employment before starting to taper those bond purchases. We're having such a labor shortage in this country right now. What's your best educated guess as to if and when we get to full employment? And if the Fed waits too long, what's the downfall there? What's the downside?
We have quite a while to go before difficulty in hiring becomes a labor shortage. When you see a labor shortage, you're saying at what price, at what wage rate. And right now, some employers are saying they can't find them at the wages they were offering pre-pandemic. People want a little bit more compensation to go back. You compare the economy now versus what we had when we had higher inflation. In the 1960s, early 1970s, the economy really ran hot. We had much lower unemployment for quite a while, and GDP was above potential. GDP has not been above potential since 1999, 2000. So we really do not have an economy that's running hot, which is what would give the inflation pressures that the Fed worries about. So they can see the labor market tightening quite a bit before they need to move.
And Jeanette,
I wouldn't disagree with that, but I would make the observation, I think there's great uncertainty as to what long-run potential is right now for GDP. And I think that if there's some place that this is going to get missed, it may be in the assumptions about the labor market. I think it's very much driven by the observation that we have 7.6 million people still unemployed. The question is how many of those are really likely to come back. So there's great uncertainty about labor force and labor force participation rates, and that's where the tightness in that particular labor market might sneak up on them.
We only have about a minute or so before we're going to be hearing from Fed Chair Powell. Jeanette, I want to come to you with this first. Just curious to know, just because we've had so much talk around this taper tantrum, some folks saying that we actually already perhaps saw it, at least in the first quarter this year. Curious to know what you see the effect of kind of yanking away some of this money, this pivot, what we're going to be seeing in real estate, in some of these other areas where folks are saying we do have a bubble right now, in part fueled by some of this money.
Well, let's hope they don't yank it away. I think that's really important. I don't think the Fed wants to yank it away, and I think that they will do everything possible to do it in that fashion. So, but nevertheless, I'm not sure. I was in the press release a little bit surprised that there wasn't a little bit more discussion about QE and what would be done there. If one looks deep into the press release, one sees that QE is somewhat positioned in this particular press release as having to do with the functioning, the smooth functioning of various areas of the market. And that's why they're keeping it in place. I think when the first question is, when will they do this? The question of how they will do this and where they will cut back and with what purpose is going to be very interesting. I don't believe the Fed has changed anything in their view in the respect that they are not there. Monetary policy is not there to affect asset prices. That is a slippery slope. That's not what the Fed does well, so that will not be the motivation.
All right, Jeanette Garrity from Robertson Stevens
Okay.
Manager.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have, specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early. Any barriers that you see keeping people from the labor market as you consider full employment going into 2023? Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame, I think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up. And at some point, they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than 1/3 of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that that would stop and that, in fact, it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though, although, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary. And we'll be on, we're going to be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thank you. Now we'll go to Elon Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Right. So I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Yellen, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer term inflation expectations? And would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. So, the shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. So yes, I think if you look at the broad range of longer term inflation expectations, they've moved up, they moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good actually to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago, at a time when inflation was still anchored and at around 2% or maybe even a little bit below. So the answer is yes, I think they are anchored and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's important.
Okay, now we'll go to James Politi with the FT.
Chair Powell. Thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment for 4.5%, and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023, showing not one but two interest rate increases at the time, is this kind of, can you describe the sort of tone of the discussion in the committee, and are we really moving towards sort of a post-pandemic stance? Is there greater confidence that the recovery will be a full recovery sooner than expected?
Your first question, the judgment of when we have arrived at substantial further progress is one that the committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is the process that we're beginning now. At the next meeting, we will begin meeting by meeting to assess that progress and talk about what we think we're seeing, and just do all of the things that you do to sort of clarify your thinking around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the two hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. In our if you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And I honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff we're very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Thank you. We'll go to Nancy Marshall-Genzer from Marketplace.
Chair Powell, continuing in that vein, when you're ready, how will you go about signaling the start of tapering when you do decide to do that?
So our intention for this process is that it will be orderly, methodical, and transparent. And I can just tell you, we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And we expect to be in that business until we reach substantial further progress and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think, but we're making progress.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can.
Great, thank you. Going to Craig Torres at Bloomberg.
Craig Torres at Bloomberg.
If I were a businessman looking at the forecast today, I would ask how and when the Fed seeks to achieve an average of 2% inflation. In other words, does the FOMC have a look-back period, or does it plan to suppress inflation in outer years? Because over the next 3 years, you're going to be above inflation. So what is your look-back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
You know, so as part of our year-and-a-half long process, the review that we did and came out with at the end of that with the new statement on longer run goals and monetary policy strategy, we looked carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that. And we concluded, and I strongly agree, that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary. There's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time, and it's meant to create a broad sense that we want inflation to average 2% over time. But that under the old formula, under the old framework, what was happening was 2% was a ceiling because all of the errors were below. You were always getting back to 2%. So you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. You're right. It's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
That pretty much answers it, Chair Powell. Thank you.
Thank you. Now we'll go to Michael Derby.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility, and do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range. And I do think it could have some effect on broader money market conditions below as it relates to, the very low rates and the downward pressures.
Okay. And do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing, you would think that it would, but we'll have to see. It's possible that would not be the case. Well, that's going to be an empirical question.
Okay, cool. Thank you.
I will go to Gina Smialik, the New York Times.
Hey, Chair Powell. Thank you for taking our questions. I was wondering if you could follow up a little bit on your response to Rachel at the very beginning and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking decent. So I guess I wonder what full employment means in this context and sort of how you're thinking about those wage data.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages and many different flavors of that. So how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply outperforming expectations over a long period of time. Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window, because people would have retired anyway, and you'll be back where you would have been. So I think the lesson number one is just to be careful about assessing maximum employment, and I think during the last cycle there were waves of concern that we were reaching full employment as early as 2012 when I arrived at the Fed, and 8 years later, we were still creating jobs, and it was quite remarkable. So we're all going to be informed by that. At the same time, we understand this is a different economy. The demographics people are getting older, and that should have a secular effect of reducing participation over time. So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling, in the sense of what would be troubling would be very wide across the economy, wages at unsustainable levels. Without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy, sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs, and but we do think you've got a thing in the labor market right now where supply and demand are just not matched up well, and we think it's a flexible economy, and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, but the last thing I'll say is, again, if you look at the forecasts, we're going to be in a very strong labor market. Pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
Thank you. Now we'll go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the status of your thinking around the supplementary leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but we've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing. And because of the substantial increase in reserves, treasuries, and other safe assets in the banking system, the SLR is rapidly ceasing to be the intended backstop that for our big firms that we want it to be. So we do think it's appropriate to consider ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. So sorry I can't give you any more. That's just something we're working on.
Thank you. Now we'll go to Annika Tepa at CNN Business.
Hi there. Thanks for taking my question. Chairman Powell, the price jumps we've seen in some raw materials, lumber, for example, you mentioned it earlier, seem to be easing, and it looks like we're at the beginning of suppliers catching up with demand. But I wonder if you're worried at all if we're going to end up with excess supply immediately after those shortages wear off, and if we just continue this mismatch as we're recovering and getting out of the pandemic economy. And I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. But actually, people who work in commodity industries are very focused on that because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected. And the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business. And we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly.
Thank you. We'll go to Howard Schneider at Reuters.
Howard Schneider, Reuters. Thanks, Chair Powell, for taking this. I don't want to miss the moment here, and I noticed that in the statement you dropped the language saying that the pandemic is weighing on the economy. So is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
It's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And that should continue. But you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates, they've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and that can only help. But you're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. Who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could follow up on that, if you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen inflation above target, though, and I think even though in our forecasters' case, they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecasts as well.
Thank you.
Thank you. We'll go to Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
So what we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023, those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change in the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and it's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do, but I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%, that it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi, thank you for taking my question. Chair Powell, I'm just looking at the forecast, and one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. But you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022 and 2 to 2.3 in 2023. So you're right. You're seeing, I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year. Coming on the back of a 7% growth year, that's a really good year. That's a year with a lot of momentum. That'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right?
The economy is not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question in a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes. And if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Chair Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect, to suggest that longer term neutral rate, or R-star, might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount. And that would be a good thing from the standpoint of the economy because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore, then that would tend to result in better outcomes for the economy over time. You know, you can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest. And we try to keep up with that, and I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. And I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think that there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're certainly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind, and the forecasts are all consistent with that. Your specific question, I guess, was, will you be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember, there was a prices were incredibly low and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that. And that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And we have to balance the two goals, maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
I think that's the last one. I hope that's the last question. I hope that. So it's over, guys. I mean, whoa, what a day. I've been sitting here for almost 6 hours, guys. That is crazy. So let me quickly round it up for you guys so that we can end this live stream, and of course I can record a video and let you guys know what is going on today. So this is the summary of what Jeremy, more or less, what we just saw. This is the summary right here, guys. Okay, for those of you that are wondering what is the meaning of all these things that this guy was talking about. So Powell, according to him, it is clear we are on a path to a very strong labor market. Okay, so this is what I'm going to tell you guys, because I have been reading a lot of all these articles out there about what is going on. In my opinion, the market is supposed to, in my opinion, this is not financial advice. The market is going to remain the same till September, from what I can see so far, till September, because according to Powell, unemployment insurance for around 15 million people, of course, in America, will end by the September. And of course, he's expecting a very strong job creation. According to him, he's expecting that we will see a strong job creation building up over the summer. So, and another point is vaccination is also increasing. A lot of people are getting vaccinated, and in Germany, for example, I have a lot of old colleagues that have already gotten their first vaccine and they are waiting for the second vaccine. And of course, I have some young people also that, they are waiting for their own vaccine. I think in the next few weeks, they are going to get vaccinated. So according to him, daycare is going to, be reopening. And once daycare is reopening and people are getting vaccinated, they are going to return to work. Okay. So everything from what I can see so far, after summer, I think at the beginning of winter, I'm talking about September, everything should remain the same according to what Powell is saying. So I think until September, I don't expect any, big drama. I don't expect anything huge to happen until September. I'm going to reduce this a little bit so that we can see the price action of what is going on with the market, okay? So until September, in my opinion, I don't expect anything. As you guys can see, NASDAQ, let me quickly remove this to this side. As you guys can see, NASDAQ went down, okay? You guys can easily see right here. NASDAQ went down, during this around 20 o'clock German time, that's like 1.5 hours ago, Nasdaq went down, and what's happened, like I already suggested to you guys, already informed you guys that there is always something like sell the rumor, buy the news. So that's more or less what's happened today. You can see people are selling the rumor and then they are buying the news. So we are more or less back to where we were, before all this, Jeremy's speech started. You guys can easily see we are back to where we were. But oil, on the other hand, like I told you guys, I believe oil is overvalued. Okay, I mean, you guys can easily see oil is not recovering. Oil keeps going down. So more or less, people were, putting money in oil because of this inflation. Maybe the Fed is going to, change the rate. Maybe they are going to increase the interest rate or not. So that's why people were buying oil. And as you guys can see, oil is correcting. So I don't expect anything, dramatic to keep happening with oil. There is a possibility we have seen the top of oil. Okay, maybe the price is going to go back to 72.55 US dollars. If it goes back to this place, it's going to create triple top, and of course I would gladly add to my short position. So in terms of Bionano Genomics, everything looks good for Bionano Genomics so far. Everything looks good. Okay, I mean, BNGO didn't even go down at all. I am watching a lot of stocks, and while they were going down, Bionano Genomics consolidate around this level, because today there was a breaking news about a new analyst from BTIG covering Bionano Genomics. And of course there have been several bullish catalysts from yesterday, from 2 days ago, from last week Friday, the new the new implement of all this, CCO, CBO, and I believe BNGO is in a very solid position so far, because even the interest rate is not even affecting Bionano Genomics. So yeah, and Tesla was more or less not doing anything today. So like I was saying, according to what Jeremy Powell said, if he said, I quote, if we look 1 to 2 years out, we will be looking at, a quote, a very, very strong employment market in the next one, from 1 year to 2 years. That means next year summer till 2023. According to him, he's expecting us to be in a very strong employment market. Okay, so if we are in if the economy right now is not really strong like they are expecting, they didn't change the interest rate, they leave everything like it was, it means business as usual. It means, the stock, your investment, if anything was going up, it means it will keep going higher. Okay, and anything that goes down today, you guys have to be very, very careful. Okay, because today, for example, gold went down, okay, and oil went down. And US dollar, you guys can see, if you are following US dollar or Euro US dollar, for example, US dollar is very strong right now because of what was happening. So you guys want to be careful with US dollar, because US dollar is right now going higher, and whenever US dollar is going higher, gold always comes down. So I think that is more or less what this guy is trying to tell us. He's expecting the job market to be very strong. He's expecting unemployment, to reduce. He's expecting employment market to be strong, towards September. That is when a lot of people get vaccinated, when daycare reopens, all these restaurants are going to reopen. Theater, for example, like AMC store, for example, cinemas are going to be reopening, and maybe some disco, all these things are going to reopen, and people are going to, go back out, and there will be a lot of job creation according to what he's saying. So that's more or less the review of what just happened today. So until September, in my opinion, once everything goes back to normal, you guys just have to be, you have to be at alert. Once we are back to business, once everybody, everything is reopened, then we are going to come back and see what's going to happen. So you guys just have to be, you have to, because this is not what the Fed were saying. Like few months ago, they were saying something else. So right now they have moved everything. The Fed forecast, 2 possible rate hikes by end of 2013. That's what they forecast. 2 possible rate hikes by the end of 2023. So that means, they were forecasting that there's going to be like 2 possible rate hikes after 2023, 2024, 2025. But right now they brought it down a little bit to 2023. So I believe in September, once most economies are reopened, I believe they are going to bring it down again to like 2022. So there is a possibility that we have, maybe till the first quarter of 2022 to make money from growth stocks. Okay, there is a possibility that the growth stocks like BNGO, for example, will keep going higher. until first quarter of 2022, and then market correction. So so far everything looks good today, and no drama. So I mean, that is all from Fed today. So let me quickly read you guys' question and see what I can answer so far. Then we can end this live stream. Guys, I've been on this live stream since 6 hours ago. Crazy. Recon, they should let me see if there is any one is representing on what. Yeah, Zach is making a lot of money from, what's the name of the stock once again? BSSP. Zach is making a lot of money from BSSP right now, up 167% today, guys. This stock market cap is just 1.1 million US dollars. This is the definition of penny stock. Look at that, 164% in one day. While most stocks were crashing, this thing was going up. And it's not only BSSP that is going up today. There is also another stock I was tracking. This stock right here, look at that, Orphazem or whatever it is, ORPH. That is the ticker. It is up 69% today, almost 70%. I think at one point it was up more than 75%, and the market cap is 598 million US dollars. But guys, EVFM is something that you guys should take a note about. Look at this stock, EVFM, EVOFM. You guys should keep an eye on this stock. Okay, the market cap right now is 171 million US dollars, and according to the market, the total addressable market is above 2 billion US dollars, I believe. 2 billion US dollars, the total addressable market, at least above 1 billion US dollars. So right now the market cap is just 171 million US dollars, and you guys should keep an eye on it. I mean, so which other stock can I quickly talk about before we end this stream? So that's it, guys. That is it. You guys can see Nasdaq is recovering. I mean, if you were day trading Nasdaq, you would have bought. You guys can easily see I put a support right here and it bounced. Okay, this support right here, because it used to be a strong resistance until it was broken on the 10th of this month. So this right here is a strong support and it's bounced. So if you were day trading Nasdaq, that was a great opportunity for you. And of course, Bionano Genomics keeps going higher. Okay, it keeps you. And oil, like I said, I'm waiting for oil to break this support. If oil breaks this support, then it's going down, baby. It is go. I need to make a lot of money from oil. I need to make a lot of money from oil, guys. Oil is very difficult to trade. I'm not gonna advise you guys to jump on it. I'm not advising anybody to follow what I am doing. I've been trading oil for since 2016 or so, almost every day. So until recently, I took a break. But right now, there is no way I'm going to resist this 71 US dollars level. It is impossible. So that is it for today, guys. Thank you so much, Zach. Thank you so much. Always representing. OTC gambles from place, but very risky. So guys, that is it. I mean, I'm going to see you guys in the next live stream, and of course I still have to record video for you guys about what is going on with Bionano Genomics today. So I mean, yeah, please subscribe if this is your first time on this channel. We talk about Bionano Genomics talk every day. And the thing is, I think maybe I'm gonna be coming online from time to time, and because this is my first time talking about the Feds, talking about FOMC, talking about interest rates. So maybe I'm going to come online from time to time, and I'll be showing you guys what is going on in the with entire market, because this is not only about stocks, this is not only about investing, this is also about about humans, okay, about the economy, about something that can affect you and I, something that can affect our family, our friends, because we are talking about employment, we are talking about the situation of the economy, the lockdown, vaccination, and so on and so forth. So this more or less a general topic that is affecting that can affect anybody. So yeah, maybe I'm going to be coming online, and I'll be sharing more information with you guys, just like today, showing some video from Yahoo Finance, and talking about from time to time about breaking news and so on and so forth. And yeah, I think it was fun. It was fun with you guys today. Thanks so much. I appreciate you guys. You guys are the best subscribers, okay, the best fans on YouTube. I'm out, guys. I'm out. Have a wonderful evening, guys. I remain your boy Dayo. This is Frunkla.